Good morning and welcome to the September 2022 UCLA Anderson Forecast Conference on the Economic Outlook and Climate Change, being brought to you today jointly with Impact at Anderson. Impact is, I think, our newest research center at Anderson, and they're dealing with a number of issues that probably we should have been thinking about 20 years ago, but we are thinking about and incorporating into our business education today. And Impact at Anderson is having a big impact in that. We are talking about one of those issues today, which is climate change and how climate change is affecting the economy and going to affect the economy. So welcome once again. We have a great program for you today. We're going to start out talking about two other aspects of uncertainty, inflation and recession. And so the first part of our program are going to be two presentations on the U.S. economy. The first is by Leo Feller. Leo leads our U.S. forecast team. And Leo, after getting his PhD at Brown University and a stint at Johns Hopkins and in consulting, came to the forecast. So he's going to be giving a presentation on our U.S. forecast, followed by Professor Ed Leamer. Ed, I think most of you know, Ed has been at UCLA for a long time, mentored many, many students, and was my predecessor as director of the UCLA Anderson forecast and my mentor. So Ed is going to talk about how do we understand whether or not we're going to have a recession in the near term or the long term. How do we interpret data? We're not going to answer a lot of questions about what exactly is going to happen, but hopefully in our presentations today, we will give you some guidance on how to interpret the data that as it comes in with respect to resolving some of this uncertainty, this great deal of uncertainty that exists today. And then actually, I didn't introduce myself. For those of you who don't know me, I'm Jerry Nicholsberg. I'm the faculty director of the UCLA Anderson Forecast. And this is my 17th year here with the forecast. And it's our 70th year as a research institute here at Anderson. Not my 70th year here, only my 17th. So I will follow the US forecast with the outlook for California, particularly the uncertainty that's surrounding this loss of population that we've seen in California, and what does that mean for California going forward. And then our final presentation in the forecast part of the morning is going to be William Yu. William came to us after getting his PhD at the University of Washington and teaching in Minnesota, and William is going to talk about unemployment and the differentials in unemployment that we see county to county, and what are the correlates that tend to explain that. So that will be our forecast part. We'll have time for Q&A. Those of you who are in the live audience here, you can just raise your hand. Those of you who are behind the paywall, you have a Slido number, and you can use that Slido number to log into Slido. If you don't have the app, it's free to download, and put your questions in there or vote on questions in there, and we'll curate those questions and try and get to as many as possible. Then we'll take a break, and then we have two of arguably the leading experts in climate change and climate policy here in Los Angeles in a keynote conversation, and we're going to explore what that means for the macroeconomy, what kinds of policies are being advocated, and what sorts of trajectories we might see. That'll then be followed by a panel hosted by and put on by Impact at Anderson that's going to drill down and look at, well, what does that mean for business and the conduct of business and how one makes decisions with this uncertainty about climate change. So that's our program today. It's a great program. I'm really looking forward to learning from our climate change experts as we go forward. But before we begin, this is our 70th year one of the reasons why we've been able to go 70 years is we have had amazing support. And I want to thank our supporters and our sponsors because, we're a public institution. We couldn't do these kinds of programs or our research without the support. And so we are most appreciative of our supporters. So let me begin with a special thanks to Richard Ziman and Steve Gordon, who have supported the establishment joint with the Ziman Institute for Real Estate here at Anderson, a position of real estate economist, which so that economist will be working with us at the forecast as well as with Simon. And in June, hopefully we'll have that person on board and they'll be talking about the forecast for real estate in our annual joint conference with Ziman. And Edison International and Southern California Edison, who have generously supported our Forecast Fellows program, which is a program to mentor students from underserved communities who are undergraduates at California State University, Dominguez Hills, in research and into graduate study in economics and finance. So many thanks to them. Our sponsors today, our principal sponsor is RSM. Our platinum sponsors, law firm of Allen Matkins, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. Our gold level sponsors, Avenue Insights and Analytics, Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Pacific Western Bank, Robert Half, and United Airlines. Our silver level sponsors are Scott Work North America, who is a new sponsor. Welcome to Scott Work. And Union Bank, the private bank. At the Bruin level, Gerber Kawasaki Wealth and Investment Management, and SoCal Gas, and our longtime academic sponsor of UCLA Extension. And so with that, let's get to what's happening in the US economy. Recession or no, inflation or no? Leo.
So I will try to be the bearer of bad news, but with a smile. And so, don't take my tone of voice and my enthusiasm as, reflecting what is likely to happen in the course of the US economy over the next couple of years. So I'll be talking about this mixed signals economy. We're expecting below trend growth, persistently high inflation. If you look at the data that's coming in, it's very hard right now to make anything that looks like a recession call because we get really positive news from some sides of the economy and really negative news from other sides of the economy. So on the positive side, we have labor market. We have growth that will likely be revised upwards when new GDP numbers come out at the end of this month. Consumer finances are still pretty strong. Consumer spending has been trudging along. Supply constraints have started easing. Government defense spending is usually stimulative of the economy, and that's starting to go up. We have more investment in energy transformation, more investment in reshoring manufacturing, commodity prices are coming down. That's all the good news side. But then there's all the bad news side, right? What's happening with inflation? It's remaining high and persistent. The Fed is going to be announcing the new interest rate increase later this afternoon, right? We're likely to get additional tightening and higher interest rates. Consumer sentiment is in the tank. Housing markets, are starting to decline. Housing prices are declining. Exports are likely to decline given the large appreciation we've seen in the US dollar and given what's going on in the global economy. And then finally, some labor unrest. We were able to avert a rail strike, but real wages have been declining for the average worker. And so we might expect continued labor unrest and supply issues related to that going forward. So the forecast is that we'll be muddling along at least through the end of 2023 before we ever start getting back to trend levels of growth. So on a quarterly basis, here's what the economy looks like. We have seen two initial numbers. These are estimates showing a contraction in the first 2 quarters of this year. These numbers are likely to get revised upwards. It's really hard to measure what's happening in the economy in real time. And then following that, we're projecting that we're going to have barely any growth in the rest of 2022 and into 2023. And only by the time we get into 2024 are we back at trend levels of growth of at or above 2.2% per year. So in terms of levels, this is what the economy looks like. We had a really sharp drop when the pandemic hit. we recovered really quickly. And the speed of that recovery, we almost got back to where we would have been had the pandemic never happened. The speed of that recovery is one of the reasons that we're seeing so much of the inflation that we're seeing right now, is that the economy really boomed, but supply had a hard time catching up, right? So if you look back, we grew 5.7% between the middle of 21 and middle of 2020. Right now, even though we're expecting a very flat economy over the course of 2022, we're still about 1.5% above where we were in the middle of 21. This is the period of time where we barely grow, 0.3%. We basically stay flat between now and the middle of 2023. And then finally, we grow again from middle of 2023 into 2024 at about a 2% rate on average. So let me note that we're having a really hard time measuring what's going on in the economy. And there's two equivalent ways to measure this. There's something called GDP, which is what you spend. And there's something called GDI, gross domestic income, which is what you earn. And these should be the same sides, different sides of the same equation, right? What you spend equals what you earn across the entirety of the economy, right? So if I buy services from Ed, that's my spending, but it's Ed's earnings. We're having a hard time measuring that. And what we're seeing is that GDP, the number that gets announced in the news, has been going down. A lot of people use the rule of thumb that 2 negative quarters of GDP means a recession. That's not the official definition of a recession. But then there's this other measure, gross domestic income, and that has still been going up, right? So if you want to be simple and say, okay, well, let's just take, we don't really know what's happening, let's just take the average of the two. The average of the two says the economy is basically flatlining, but not declining. We're not yet in a recession, just based on, this GDP number and the likely revision that might come from it. Also, the labor market seems to be really going very strong, and that's not indicative of us already being in a recession. So right now, unemployment is at about 3.6%. We expect the labor markets to slow down as the Fed increases interest rates. That will slow down consumer demand. That will slow down hiring. That means that we should see unemployment increase. We have unemployment increasing pretty gradually to a peak of 4.3% at the beginning of 2024. This scenario right here corresponds to a scenario where the Fed does not try to get to 2% inflation. So I'm going to talk a little bit about that further on, but I do want to note that one of our principal sponsors, RSM, has this modeling work that they did that said, look, if the Fed is really trying to get to 2% inflation by end of 2023, beginning of 2024, we expect unemployment to go above 6. Right? If they allow inflation to stay between 2 and 3, right, we don't quite hit the 2% inflation target, then we're going to get some kind of unemployment between 4 and 5. And if the Fed just says, okay, I guess we're going to accept more inflation and allows inflation at 4% or above, then we actually have unemployment remaining low. This is the middle ground. This is the Fed, tolerates a little bit higher inflation, but at the same time, we don't get an extreme jump in unemployment and we don't get a recession during these next 12 months. Because the labor market is slowing down, we're expecting wage growth to slow down. So right now, wage growth has been growing at about 5% a year. We measure it in terms of something called ECI, which is the Employment Cost Index. This takes wages and benefits into account. On average for workers, wage growth plus benefit growth has been about 5% per year over this past year. We expect it to get down to about 3.7% per year, which is still above the historical rates that we had in 2018, 2019, substantially higher than the 2% rates that we had coming out of the great financial crisis. We'll talk about why we expect continued strong labor demand and higher wage growth going forward. So with this, the economy is still moving along. We still have very high inflation. Inflation has started getting baked into consumer expectations. We expect inflation to remain high through the end of 2024, right? Not getting back to a 2% target. So in terms of headline inflation, we are at 8.5% year over year right now. It's been flat since the second quarter, right? That has to do with oil prices beginning to come down. So we haven't had an additional burst. Inflation hasn't been accelerating, but on a year over year basis, we're still at about 8.5%. We expect that to get down to 4.3% by the end of 2023, year over year, still, about double the Fed's target of about 2%, right? And then by end of 2024, we're at 3.1. If you take out volatile food and energy, food is one of the places where we've seen some of the highest inflation, 13.5% inflation on food. I'll be featured on CBS Evening News later today, this evening, I guess, by definition, CBS Evening News. And we'll be talking about how inflation was higher at places like Dollar General than at places like Walmart, and then at places at Whole Foods. Whole Foods saw about 8% inflation year over year. Dollar General saw about 24% inflation year over year. And that's because, Whole Foods is expensive. People can shift away and, in search of bargains and in search of cheaper prices. But by the time you get to Dollar General, that's the lowest cost option, right? And so we see consumers under this kind of stress from inflation where they're gravitating towards lower and lower cost options. And that's causing higher inflation at places where consumers really tend to, lower income consumers really tend to shop. We've talked about the decline in oil prices. We've already seen a lot of this decline. There's a great podcast that we have on why California still has such high oil prices such high gas prices, and it's slower to decline in California. We expect oil prices to get down to about $80 a barrel, still remaining much higher than we had during the 2010s. But it will take a while to pass through into consumer prices, and we haven't really seen that yet. We didn't see this in the past CPI. So this is one of the things that will likely help reduce inflation. It just hasn't been passed on to consumer prices quite yet. All right, so with the high inflation, we'll see this announcement today. We're expecting the Fed to raise interest rates by 75 basis points at its announcement this afternoon. The question is, with tighter monetary policy and higher interest rates, can the Fed Reserve engineer a soft landing where the economy does not go into a recession? The answer is that history does not bode well on this. So every single dot here is an episode where the Fed has been trying to tighten monetary policy. And every time it's red, that means they've tightened and we've had a recession within 12 months. Every time it's green means that they have tightened and we have not had a recession in the next 12 months. Well, right now, the odds are 75% just based on this, that we would head into a recession, right? 3 out of 4 times when the Fed tightens interest rates, we go into a recession. And the question is this time different? What are the factors that might lead us to be closer to those 3 green dots than to the 9 red dots? Those 3 green dots had something special, which is something else was going on in the economy that was kind of a compensating differential, the Vietnam War, right? Investment in internet and new technology that kept the economy running along, even though the Fed was tightening interest rates. And what is that now? Is it investment in climate change technology, right? What is it going to be, investment in infrastructure? What is it now that might power us through without us going into a recession despite these rising interest rates? So our forecast is that the federal funds rate is going to get to about 4.0 to 4.25 by the end of this year, that it will peak at 4.25 to 4.5%. Last time we presented, we said the mortgage rates were going to peak at around 6.5% for the 30-year mortgage. We actually turned out to get that one right, unfortunately, which means that mortgage rates are already around 6.4%. We don't expect it to go too much higher because mortgage markets are looking out over the long term. They're already expecting the Fed to get to this 4.25 to 4.5% benchmark rate. So with higher interest rates, we know that we have declining housing markets. We are expecting housing starts to really slow down, so less home construction, getting down to about 1.3 million units per year. John Burns Consulting, who presented last time, said we need about 1.7 million units just given the demographic growth. So we're going to be building less housing than we need to sustain demand for our population, right? So there has to be at some point in time, catch-up construction if we're not going to face the issues that we had, over the course of this past decade, which is really rising home prices and people being priced out. We are expecting home prices to decline about 6% nationally. We saw this big jump where home prices increased 20% year over year. We expect to get down to a 6% decline nationally. This is going to vary hugely by market, right? If you're the Boise's and Jacksonville's and Tampa's and Phoenix and Nashville's that had the big run-ups, you're more likely to have larger drawdowns. If you're places like San Francisco and Chicago that never really had a big run-up to begin with, you're less likely to face a big drawdown in home prices. Despite all of this, right, consumer spending has remained fairly resilient. So This graph, I want to show you that even though prices have increased, consumer spending has remained about constant. They just keep putting less stuff into their basket. And so if you look at a supermarket, what consumers are spending, this is going to be that middle blue line, right? It went up during the holidays, it came back down. Consumers are spending about the same on their overall, grocery cart as they leave that supermarket. But each item in that grocery cart is now more expensive. And so they have fewer items in that grocery cart. And that's what this graph is showing you. Prices go up, number of items go down, consumer spending at the supermarket remains about the same. What this also shows you is that people are cutting back on the number of units that they're purchasing, and they're cutting back on discretionary items. So toys, 20% down in terms of the units that people are buying, right? Merry Christmas. This is going to be a harder Christmas if people are going to be having a hard time, focusing on some of these discretionary things like toys. Where people aren't cutting are pets, babies, and grocery, right? You make sure you feed your pet, your baby, and yourselves, and you cut things like toys and home and garden and electronics. So we're already seeing that happening. Consumers are saving a lot less on their savings rate right now is about 5%. This is below a lot of the spikes that we saw during the pandemic as people couldn't go out and consume services, and as people were getting the fiscal stimulus checks, they were saving a lot more. Consumer credit has increased substantially. The consumer credit side is reducing some of the potential for consumers to go out and power through higher interest rates in a tougher economy. It makes it less likely that they're going to be resilient. These lower savings rates just say that they're saving up a lot less, but consumers are still sitting on about $2.5 trillion in additional savings, right? Over the course of the pandemic, people saved up a lot of money. And this is really, and again, this is a reference to something that John Burns mentioned in the last conference. If you used to have 1,000 in your bank account, you have about 3,000 now. If you used to have about 4,000 in your bank account, you have about 12,000 now, right? People have about 3 times as much in their bank accounts than they used to. They're not saving up anymore, but they're beginning to draw this down at a very slow rate. So you can see that we peaked and we're pulling back a little bit on the amount of additional savings that we have in our bank accounts. We have recovered almost back to trend in services consumption. We've gone out and started consuming restaurants. More of you are here. Thank you for coming in person. Right, it took a lot of services to get you here. You are consuming dining services, you had to drive, you're consuming parking services. So this is some of the services that have been coming back, but we have been pulling back on non-durable goods and on durable goods. As we have shifted to services, we're buying less stuff. Consumers are obviously very pessimistic about the economy. Prices are high. There's concerns about the economy slowing. Almost every time consumers have been this pessimistic about the economy, the US has entered a recession, right? Right now, consumers just keep powering through. And you can tell that we're in a recession because even Cardi B, or that we might be into a recession, we're not in a recession yet, but you can tell that we might be heading into a recession because consumers are really fearful that we're heading towards one. And when even Cardi B is asking about whether or not we're in a recession, right? Maybe that means that, it's become more likely over time. So 3 out of 4 consumers, if you ask them today, do you feel like you're in a recession? They say yes, right? We're not in one yet. But consumers definitely feel like they're in one. And consumers say that their biggest personal concern is personal finances. That's 2 times as many as people that say world events, right? What's happening in Ukraine. Only 7% say they're really worried about COVID, right? Joe Biden declared the pandemic to be over. Consumers seem to have declared that a little while back. All right, so my last 3 slides to close. We expect exports to dip. That's going to hurt us a little bit in terms of how fast the economy is going to grow going forward. There's been a lot of currency appreciation. The US dollar is more expensive, but great for all of those of you who want to go to Italy and stay at cheaper Airbnbs. We expect defense spending to increase. This has become a more dangerous world. Defense spending should be a nice tailwind to the US economy and help us potentially get through some rough spots over the course of the next 2 years. And finally, we are investing more in reshoring, and we are investing more in climate change and developing climate resiliency. That means that we expect business investment to keep trending upwards, even as interest rates have come up. So we are in a mixed signals economy. My last reference here is to Squid Games. The way that I feel about what's the likelihood of us entering a recession is, I think, the way that I would feel about participating in this red light, green light game. It's pretty uncertain. And we'll really have to wait and see what happens as we move forward. So with that, thank you very much.
Thank you. So Leo has revealed that the way we see the future is by looking backward. And my view is we should take a very close look at the 70s to see what happened at that period of inflationary excess and how the Fed prevented or stopped the social disease of inflation. We have Arthur Burns, who was operating the Fed in the middle of the 70s. He jacked up interest rates, causing a recession. Inflation backed off. It got hot again when Volcker came in at the end of the 70s. And Volcker said, I'm stopping this. This is not going to occur anymore. So he jacked up interest rates sky high. We had a terrible recession. That was the end of the inflationary period in the 70s. So the question is, are we about ready to repeat that? If so, you need to think about your portfolios in terms of what worked in the 70s and what didn't work. If you had invested in the S&P in 1970, you weren't back to that level in real terms until 20 years later in 1990. So the S&P index, what was great in the 60s, was not in the 70s. You need to organize your portfolio to deal with those risks. Leo has already given you lots of pictures that tell you the evidence. I'm a big believer in that. And I'm going to give you these kinds of images. We're going to look at a bunch of expansions. This is the image that has the horizontal axis, the months before the next recession. 36 means 3 years, 36 months, 24 and 12. So at the left, that's 3 years before the recession, and 2 years and 1. That was the expansion that ended in 1957. That's inflation. So inflation was low 3 years before the recession. It was came up a little bit, and it got much worse in the year before recession, suggesting that high inflation would be a potential indicator of a coming recession. So let's add all these other episodes. That one was Burns, by the way. That's Arthur Burns. You can see he was facing very serious hike up of inflation. That's Volcker. The dots represent when Volcker took over as the Fed chairman. Inflation over almost 14%. And that's 1990, that's 2001, that's 27, and that's the average. So I'm going to look at, summarize this data in terms of average standard errors, correlations, and then try to put into this picture the most recent 12 months to have it fit most accurately these 7 episodes. So around that mean, I'm going to put one standard error band, and then I'm going to put the actual recent data, which is right there, in a way that fits within those standard error bands. And that puts us at the last month before recession. That's what the econometric says. If you move those triangles to the left, it gets outside the band. And the econometric says that's not where that data belongs. It belongs over here on the right. So that's what I'm going to do. I'm going to show you these visual images. And into that inflation, I put where we are. We have worse inflation than Volcker did. The good news is the last couple of months, it's abated a little bit, and that could continue to apply. But otherwise, it looks like we're at the end of the expansion, according to inflation data. Another thing that's important when you think backwards, you've got to be careful not to make mistaken use of data that don't apply in the future. And here's an example. The CDC said that we've lost 2 years of lifetime. The life expectancy has fallen by 2 years. And I'm telling you, nobody in this room has had a 2-year reduction in their life expectancy future. That's historical deaths that reduce the average age of death. But that doesn't mean it's a forecast of what comes next. If COVID-19 doesn't come and start killing us off again, we're going to have the same kind of life expectancy that we had before COVID-19 took place. So those are life realizations, not life expectations. And now we're in extremely difficult forecasting enterprise because the recent history is so different. And here's an example of it with the unemployment rate. So you look at the historical unemployment rate, And it has its ups and downs and ups in recessions and et cetera. But there's nothing like that spike up in COVID-19. So in order to study the unemployment data, I'm going to eliminate that COVID-19 interval and act like we've been in this long expansion with declining unemployment that continued on. We're going to eliminate that spike. And if you do that, this is what happens. Unemployment is falling in the 2 years before recession, then it flattens out. So flatten out means that the labor market doesn't have the ability to put more people to work. And that means probably a fragile labor market. And the Fed is totally unaware of this phenomenon. They think, oh, this is really great, low unemployment. We have to worry about inflation because we have low unemployment, but they don't have an awareness of the fragility that low unemployment means. You're more likely to be at the end of the expansion. And here we are. The squares are the hypothetical with the COVID-19 excluded. The diamonds represent the unusual data that comes from COVID-19, but it wants us to put it. It says it's about 6 months away from the recession. If you put it optimally. Here's interest rates. So you can see Volcker and Burns jacked up interest rates tremendously. Over here at the left, Burns, by the way, changed his mind and said, oh, I made a mistake. I got to lower the interest rates before the recession occurs. Not Volcker. He jacked them up to 12%. Here we are on the left. That's the optimal placement. That those low interest rates don't fit well into historical data. It makes it hard to know what's really going on. It's a huge spike up, which seems troubling, but extremely low rates of interest, particularly low rates when you would subtract off inflation. Here's the slope of the yield curve. This is the one that's usually think as the most reliable indicator. And it's the difference between the 10-year yield and the 3-month yield. And that slope of that yield curve is very great, like 200 basis points, 3 years away from the recession. But as the Fed raises interest rates, it gets flatter and flatter and inverts about 4 or 5 months before the recession. You can see Burns and Volcker had record numbers of inversions. And you see the August 22 data. We used to have a steep yield curve a few months ago, and the Fed has said no more. We're going to really raise these interest rates. As we talk right now, they're about ready to raise it another 75 basis points and make that yield curve all the flatter. And so why does that matter? The reason is the banking sector takes deposits at low rates of interest and makes long-term loans at higher rates. That's called intermediation. The banks serve as intermediation. And when those intermediation profits disappear because the yield curve flattens or become negative because the yield curve is inverted, then the banks don't make the intermediation profits. And the only way they can make profits is be able to identify the credit-worthy borrowers from the credit-risky borrowers. The result of that inverted yield curve is they have steeping, increased lending standards. Much more difficult to get a loan. And if you've had a housing market giving loans to people who really shouldn't be getting them, all of a sudden that's over when that yield curve inverts, because the banking sector is going to be much more aware of the risk that they face. So I've been, 3 months ago, I would have told you it's a Wall Street problem, not a Main Street problem. Meaning bonds and equities are going to be suffering from the inflation and the rising interest rates. But I thought the Main Street might be able to get through this problem. And we're going to look at 2 Main Street issues. Here's the housing starts. Anyway, here's housing starts through July 22. And you can see over at the right-hand side, they're declining. But the most recent data is improving. And the result is that the placement, the econometric placement of that data shifted from the year before recession all the way to the left to the 3rd year before recession, because housing starts reversed, came back up in that month. So it reveals how fragile these results can be. But the conclusion overall is not so fragile. So if we had the data only through July 22, it would say there'd be a 57% chance we're in the last month. And with the new data, it falls down to 37%. So it's still pretty risky from the housing standpoint. And what about weekly hours in manufacturing? Typically, weekly hours are on the rise. during the expansion. And you look at over the left, you see 40.5. That's 40.5 hours per week, which means overtime. And increased overtime is occurring in those couple of years, 3 years before recession. But when the demand for manufacturing products softens, they don't lay off workers initially, they cut down the overtime hours. So this has been historically one of the best indicators of on the Main Street side of an economic downturn. And you can see that historically it is a big downturn, and there we are. So to me, manufacturing is signaling, is issuing the most, the clearest and loudest signal about a coming recession. It's really cutting back on hours worked in manufacturing. So this is something I want to take a look at, though, which is how important is that housing and manufacturing. And this is an image that shows you the log of housing starts. And in the midst of it, I've drawn a blue line that represents normal housing units. And that blue line is based on the growth of the civilian population over 3 years previously. So these are new people who are added to the population, and they need to have homes built for them. And the picture says that that blue line is mapping out the center of the historical variability in the housing starts, which is up and down. But housing starts is really a wild enterprise where it's way higher than it should be and it's way lower than it should be. So back in that previous expansions, we had a serious overbuilding, which had to be dealt with by underbuilding in 2010, 11, and 12. And we are starting to overbuild, but we haven't gotten to the extreme overbuilding that we've had historically. So I don't think the housing market is as fragile. Certainly, we haven't had the kind of subprime lending that was characteristic of the last economic downturn. And then what about manufacturing? This is the fraction of workers in manufacturing. It used to be over 30% back in the 50s. It's been declining. It's now only 8%. It's not that important part of the economy, even though our manufacturing sector could be cutting back. It's not going to have a big impact on GDP growth overall. You can see that here. This is industrial production, manufacturing industrial production, which was growing at 3.9% from 1919 until 1999. A very powerful long-run growth, and then it completely flattens out. So manufacturing isn't contributing to economic growth anymore. It's totally stabilized. We're in a post-industrial world, and we need to figure out, because we're making a transition from an industrial to a post-industrial world, we need to figure out what's going to happen that's different in this post-industrial world, and recognize that when we look backward and see what's happening in the industrial world, it might not be giving us a great idea about what comes next. So my conclusion is the Fed's flattening the yield curve makes it probable that a recession will occur soon. I think that becomes almost unavoidable. They're going to raise it again today, and they're not aware of the recession risk that they create. There's no econometric evidence that a mild rise in interest rates is going to stop inflation. Expansions end with low unemployment rates. That too is another source of worry. The declining housing starts raises concerns, but I don't think you're going to have the kind of crash that you had in 2008. We're not anywhere near to that overbuilding. So you could have weakness, the kind of weakness that Leo has talked about in the GDP, but maybe a very mild recession. And the same point about how manufacturing. It looks like manufacturing is on the verge of having a significant contribution to lower GDP growth, but it's so unimportant in this post-industrial world that we're in. Maybe it's nothing that we need to worry about. But the bottom line is, I'm way more worried. And back in June, like I said, it was a Wall Street problem, not a Main Street problem. Now I started seeing it showing up in Main Street, and I'm thinking, oh my God, I'm not so sure. Thank you very much.
Thank you, Ed and Leo, and you guys are pretty gloomy. And I'm going to talk about California. So let's start and look at this image that's from the National Review called California Leaving, which sounds pretty gloomy also. But if you look where they're driving, they're in Big Sur. So if they're in Big Sur, my guess is they're not going to make it any further than Morro Bay. What I want to talk about is this Cal exodus. California's been losing population about 0.5% per year over the last 2 years on average. And the question is, what does that mean for the California economy going forward? Is this an implosion of the California economy, as some of the East Coast press might want you to think? Or is it prosperity in the California economy just spilling over? Is it high housing prices causing a hollowing out of the middle class? Kind of what's going on and how does that inform the forecast? So that's where we're going to go. And we're going to first talk about employment numbers and GDP. What does that tell us about what's been happening in the last few years, particularly as it spans this recession? And then tech. Tech has been driving the California economy for the last 2 decades. It's been one of the important drivers. Is the party over? Is that all going to Austin and Nashville and the like? And then 3 sectors that I want to take a quick look at: government, in particular state government, logistics, which has been a strong sector, and housing, and that'll bring us to the forecast. So let's jump in and look at some employment numbers. What you see in this graph is non-farm payroll employment in California. You can see the big dip there, which is the 2020 recession. It's a 16% decline in employment, a huge decline. But as you move from that trough, you see a very steady increase to where we're only 0.3% below where we were prior to that recession. Now, you might think, well, you're going to get trend growth in the labor force, but remember, we've had some of our labor forces left. So this basically is a full recovery numerically of all the jobs. But the jobs that have come back are not necessarily the jobs that have been lost. And we can see that in this graph. This is the change in the number of jobs by sector from prior to the recession, February 2020, to August of this year. And over on the right-hand side, where are we not in full recovery? Leisure and hospitality, other services, local government. And at least the first 2, which are the big ones here, those are high human contact sectors. They haven't recovered. Where we have recovered are these 3 sectors. The first one in green there, that's logistics. And we've not only recovered, but that sector has grown. And the other 2 are tech-intensive sectors, information and professional, scientific, and technical services. So tech has been growing and logistics have been growing, and those are powering, along with construction, the California economy. So what has that done to the production of goods and services? You know, we measure both employment and GDP. And what I want to do is look at the same span of time from prior to the recession of 2020, so the 4th quarter of 2019, to the latest data we have, which is the 1st quarter of 2022, and compare states. How bad is California doing relative to other states? The answer is not bad at all. So California is there oops, I missed one. Backing up, what's happened in the last 3 months? So there's tech. Tech is still growing in the last 3 months, but that's the one that we're going to get to in a little bit. That's logistics. It's actually been losing jobs. Okay, now going to GDP. Sorry about that. So California is there in gold, is number 2. State of Washington is number 1 in GDP growth. Washington is about 6.9%, California is 6.3%. We have friendly rivalry with Florida, which is there in orange, and Texas in Longhorn burnt orange. And they grew faster than the US, which is all the way over on the right-hand side, but not as fast as California. Well, there are 2 ways that GDP can grow. One is you get more production per worker. Might not be the same worker, but you get more production per worker. And the other is you have more people. So if you have more people coming in, if you have migration into the state and they're doing something, that's going to add to GDP. And that's why China has the 2nd largest GDP in the world, but is still a very poor country because they have 1.4 billion people. So let's adjust for migration. And what happens there? California is the fastest growing state at over 7%. So it went up a little bit because we lost population, And you see it really makes a difference here. So what's happening, and this is kind of important as we think about the social issues vis-a-vis California, what's happening is that migration out of California tends to be middle to lower income Californians who are looking for less expensive housing or other job opportunities. And those who are coming in tend to be more highly educated, and William's going to speak to this when he talked about unemployment, more highly educated, more productive in the sense of producing more goods and services, and that gives us our growth. So this is the past. Before we get to that, this is just illustrative of this. This is inequality by state, and New York, Massachusetts, and California, information economies that has the most inequality by state. This is the top 20% of households by income divided by the bottom 20%. And if you look all the way over the right, states that have more manufacturing, also something William's going to talk about, Wisconsin, Minnesota, Indiana, they have less inequality. And as Ed has talked about many times in the past, manufacturing used to be a means to upward mobility in the US, much less so in the information economy. So that's really a social problem, that socioeconomic problem that is facing California and other information intensive states. Okay, so this is the past data. What about the future? Well, when you want to look at the future, let's look at who has skin in the game. Who stands to lose if they bet on California and California is imploding? And those are investors. And the chart on the left-hand side is foreign direct investment by state. So these are foreign companies that can choose any of the 50 states. And more of them are choosing by dollar volume California than any other state. The next states are Massachusetts, New York, and Pennsylvania. The right-hand side is venture capital. And again, venture capitalists, they can go to Austin, they can go to Nashville, they can go anywhere, and they're coming to California. This is 2021 data. Compared to New York and Massachusetts, California is getting about 4 times the amount of venture capital investment, compared to Texas, 17 times the amount. So these folks, as they put their money, kind of where their mouth is, are saying the future of California is still bright. This is 2021. What's happening in 2022? Same thing. This is by region. The top bar there is San Francisco Bay Area, of course, dominating. But look, as you move down there, New York is next, but then Southern California and the greater Boston area are tied. So our part of California down here in Southern California is also now receiving a significant amount of venture capital investment. So what's been happening over the last 3 years says that though people are leaving, is not indicative of an implosion of the California economy. What investors are saying is, and that's not going to be the future either. So that's at least mitigating some of the gloom that you're hearing today. So what about state government? This is cumulative general fund revenues by year. So these are by fiscal years. And the top line there is the year that just ended in July. And if you look, of course, it accumulates over the year as the state collects revenue. If you look on the right-hand side, we are above the past 3 years. To put numbers to that, what the state has been doing is putting some of this general fund revenue into rainy day funds and reserves. And there are 3 of these funds. Plus there's a surplus this year. And if you add them up, you get about $60 billion, not counting borrowing facility, that the state has available to span any recession. So the kinds of things that we saw, for example, during the Gray Davis administration, where we had a recession and state government had to cut back very dramatically because of a loss of revenue, they don't have to do that this time. So this recession that Leo and Ed were talking about, that is a possibility, and it's what they're talking about is a mild recession. State government is really not going to be impacted by that, state government revenues. So that's good news. Here is logistics, and we saw that logistics was losing people over the last 3 months. Number of payroll jobs was declining. This is California Seaport traffic, so goods coming in and going out. The top line is goods coming in. These are the four largest ports in California: Oakland, Long Beach, Los Angeles, and Stockton. And the top line is imports, and you see it wiggles around a bit, but it's pretty flat over the last year. The bottom line is exports, as Leo talked about. Exports are declining because as bad as the US is, everywhere else is worse, right? So in terms of goods movement at the seaports, that's at best flat to negative. Goods movement by air, the left-hand side is international air cargo, and the top line is outbound. The top line is inbound, bottom line is outbound. And you can see that it was growing. And these are time-sensitive goods. This is where chips always come in from Asia in air cargo, but now it's flattened out, and both of them have flattened. The right-hand side is domestic. So this is all of the major airports in California. And again, it's flat. So what this tells us is, at least for logistics, the party's over with. There's going to be some growth because we still continue to shift our purchasing to online, but goods movement through seaports and airports is flat and is not due to grow by very much in the coming years.
The loss in logistics, is it in particular sectors that are coloring other sectors that are doing well?
So the sectors that we saw before, and I'm going to come to that. Let me make a comment on that momentarily. So in terms of housing markets, as both Leo and Ed have talked about, housing markets are weak. And on the left-hand side is California median home prices. They've fallen in the last few months by over 8%. Okay, but that's median home prices, and median home prices are half the homes sold for more and half sold for less. And if the ones that are selling for more, less of them sold, that median will come down. So part of that's compositional. Part of it is price discovery because we have higher interest rates and sellers and buyers are trying to figure out the price. But prices, part of it is general weakness in housing markets. On the right-hand side is new single-family home sales, and they have plummeted. They just went back up, but it's still 30% below that average. So we have weakness in housing markets, but there's good news here for California, and that is that housing starts, as evidenced by housing permits, have gone up. And the reason is we have a changed housing environment in the state of California, where laws passed by the state legislature have made it easier to build ADUs. In the county of Los Angeles, 20% of new permits are ADUs. In the state, it's about 14%. And so unlike the US, where it has pretty much the same housing build environment, like as in Phoenix, for example, in California, it's a different environment. And in fact, we're going to grow the number of units as we get into 2014, and we're going to kind of buck the US trend here. And that's going to help in construction as one of the sectors that is not going to decline in the way that we're going to see nationwide. So that brings us to California summary, California tech, government, and construction. So this is the answer to your question. They're expected to continue to grow, but at a slower rate. Logistics growth will slow to a crawl in 2023. Jobs lost, so this is like leisure and hospitality and other services. It remains concentrated in these high human contact sectors, but that gap is closing. And the defense buildup and infrastructure buildup that Leo talked about in the federal budget, but also defense purchases by our allies abroad, is going to disproportionately buoy California's economy, because that's going to be for sophisticated goods, sophisticated defense durable goods, and that's what we do here, particularly in Southern California. So just some numbers, employment growth is going to slow, but we are fairly close to full employment, although the unemployment rate is going to rise, and it continues to rise, and it actually goes up to 4.8%, but that's new entrants to the labor force happening there, and a slowing of outmigration. Housing, slowing down to just about 110,000, then up to 140. If you're thinking about 140,000 units, that's going to start impacting affordability. It's not. It's still a very small amount of additions to the housing stock. And then finally, real personal income, that negative there is the end of the transfer payments. And then by the time we get to 2024, we're still outperforming the US. And so we have headwinds for the economy, but relative to the US, California is still expected to do better. And so with that, I'm going to conclude. Thank you. And I'll turn this over.
Hello, good morning, everyone. So today I'm going to talk about what explains the variation in unemployment rates across the United States. So this chart shows the county unemployment rate in June 2022. So you can see the blue color represents the county with the lower unemployment rate. The darker the blue, the lower the unemployment rate. On the other hand, the red color represents the county with high unemployment rate. The darker the red, the higher the unemployment rate. So in this full employment period, why do we see this difference of unemployment rate across the nation? So just now, Leo and Ed talked about the cyclical component of unemployment rate from the business cycle perspective. But today here, I'm going to talk about the frictional and structural components of the unemployment rate from a cross-sectional perspective. So here on the top left, this is the distribution of unemployment rate by county in April 2020. The peak of the pandemic, we can see the wide range of unemployment rate. On the bottom left is the distribution of unemployment rate in June 2022. We can see the significant reduction of the variation, but there's still a sizable difference. On the right, we can see the unemployment rate in California. So here on the top, you can see San Francisco County is 2% unemployment rate in June 2022. Orange County, 2.6%. Riverside County, 3.6%. Los Angeles County, 4.9%. So why? These counties are all in California, but with so different unemployment rate. So to answer this question, I conduct several multi-variable linear regression, and I focus on two target variables, unemployment rate in June 2022, and another one is employment to population ratio of a county, which is a more straightforward labor market measurement. So for the explanatory variables, I look at the two major categories of variables. One is a social, economic, demographic variable from American Community Survey in 2019. The other one is industry job share variable, which is the sector job number divided by county total job number. And this is the result from the two major models results. So here we find one of the most significant factor predictor is human capital. So in this chart on the left, the horizontal axis is the county. So the blue dot represents the county. So the horizontal axis is the city human capital index. We developed this index 10 years ago, which is the weighted average of education attainment of the local adult residents. So basically we can say 1/10 of the index is about average schooling year of that county. So vertical axis is the unemployment rate in June 2022. So basically we can see a clear inverse relationship. A county with higher human capital has a low unemployment rate. On the right, the vertical axis is the employment to population ratio. We can see a clear positive correlation. So why is that? So in general, we can see a county with a higher human capital workforce, they are more likely to get a job and remain employed in this information knowledgeable economy in the 21st century. And the second reason could be coming out of this recession. So the service sector involve a lot of low skill, low educated workforce that got hit much more during this pandemic. So here on the left, I show you the color code by county of the city human capital index in 2021. So the blue color represents the county with higher human capital, and the red color represents the lower human capital. On the right is the unemployment map I showed you before. So we can see some kind of similarity of the color allocation, but it's not a full story. But we can say unequal human capital across the country partially predicts the unequal unemployment rates. So there are other factors. So we find that a county with a more larger share of younger adult population with the age between 20 and 34 has a higher unemployment rate. And the reason could be younger adults, they are more likely to quit jobs and search for new jobs. And this is what we have been seeing over the past 2 years. A county with a higher population density has a higher unemployment rate. So again, that could be in the urban area compared to the rural area, people are more likely to quit job and search for new jobs. And a county with larger population has a higher unemployment rate. It could be, as Jerry was talking about, over the past 2 years, the big city like New York City, Los Angeles County, we see this net out migration to a smaller city with a lower cost of living. And when a city are losing people population, they also lose this job opportunity. And number 4 is the COVID-19 mortality rate. So this is very straightforward. A region got hit harder by this COVID, they might have a higher economy and household loss. And finally, median home price is not related to this unemployment rate. So cost of living might not be the direct factor. So here, this is a very interesting factor we find. We find that a county with a higher job shares in the manufacturing sector has a lower unemployment rate. So on the left of this chart, the horizontal axis is the county's job share in the manufacturing sector, and the vertical axis is the unemployment rate. So we can see by and large, there's an inverse correlation. So in this multivariable regression setting is very significant. On the right, you can see the blue color represents a county with a higher share of manufacturing. So in fact, this is very different from the past 3 recessions, as Ed was just talking about, and he talked about this before in the previous conference. So in fact, in the past 3 recessions, manufacturing sector was a drag to a local economic recovery. So when, for example, when recession hit, factories shut down and never reopened, and jobs were shipped overseas. So here, so in 1990, we can see this L-shaped recovery in the manufacturing job number. And in 2000, it's even worse. Okay, it's not even an L. And 2008, another L-shape. However, this time, we got V-shaped job recovery in manufacturing sector. Okay, so people are talking about this phenomenon called American manufacturing renaissance. So we might be in the beginning of that, and we might be in the beginning of the reshoring manufacturing job, as Leo was talking about. So I think the question is how high of this recovery slope will be. So I think this declining slope of manufacturing job over the past 4 decades might be over. And why is that? Because we have seen all kinds of problems of global supply chain, especially over the past several years. So right now we are focusing more on resilience, security, rather than efficiency of the globalization. And finally, I would like to talk about this. We found that a county with a higher micro business activity has a higher employment to population ratio. So on the left, I show you this so-called micro business index. We developed with the partnership with GoDaddy, we developed this micro business index, which is comprised of the 3 components: digital infrastructure of a county, such as the assets, ownership of a computer and broadband, and the online micro business density and participation. And the third one is the online micro business engagement. So you can see on the left, the blue color represents the county with a higher micro business activity. The red color represents a lower micro business activity. So on the right, I can show you the vertical axis is employment to population ratio. The horizontal axis is the county's micro business activity index. And we can see clearly there's a positive correlation. So if you guys want to interested in more this research in micro business, we have this quarterly update. You can see the report in our Anderson Forecast website. So that's all for my presentation today. Thank you very much.
Thank you, William. And so now we have some time for questions. Let me start it off, and I think we have some questions coming in on Slido. So Remy, I want to make sure that we've answered your question. And in California, what we're expecting over the next couple of years is technology which permeates many, many sectors, but is more concentrated, for example, in professional, scientific, and technical services, to be one of the growth sectors, along with construction and state government. And so generally, strong sectors that are going to propel the economy. We're going to see more defense spending, and that's defense durable goods. That's going to impact Los Angeles, Orange County, and San Diego more than other parts of California. So the weakness that we're seeing is kind of temporary weakness in some of the housing sectors, in particular single family housing developments, although there are a lot of new ones that have been permitted, for example, 5 Points in Los Angeles, and weakness in finance. And so that's one of the areas where we're seeing layoffs is in mortgage brokers and real estate brokers and the like. So those are kind of the weaker sectors. What are we seeing nationally? How is that different?
So nationally, I think, we're seeing a decline in retail, right? This has already been announced by a lot of retailers where they're actually saying, we're going to be cutting back because people aren't just buying enough stuff, right? They're not buying as many goods as they were buying before. We expect this decline in logistics because also as FedEx announced, right? As people are buying less stuff, there's less shipment of goods across the US. Services so far still remaining pretty strong, right? People are still returning to services. There's some question about whether or not this was a release of pent-up demand, right? We were all going to go out and take those vacations and, consume at nice restaurants and go to shows and go to sports games, since we haven't been able to do that for the past 2 years. I guess one of the terms for this is revenge spending. Has the revenge spending seen itself out? And now we're going to kind of pull back a little bit. So far, it's too early to tell on the services side. It's really on the good side of the economy that we're seeing a contraction. On the plus side, medical care, right? This is all that, deferred medical care that people weren't getting over the course of the past 2 years because you didn't want to go to a doctor, if you didn't have to. We've seen, a lot of demand for medical care go up. It's also one of the reasons that we've seen high inflation there, right? So that tends to indicate an expansion in medical care services. Governments have struggled in terms of trying to fill employment, right? We've seen a lot of examples where, there's not enough teachers for classrooms, there haven't been enough bus drivers, there hasn't been enough trash collection. In Chicago, the trains are running, with significant delays because there aren't enough train operators. And they're recently advertising that even if you have a criminal background, as long as it wasn't for anything too bad, you're welcome to apply to be a train conductor at the CTA. So I think government is going to be able to finally be able to hire more. It's one of the areas that has been lagging simply because they haven't been able to be competitive against the private sector. So some bad, but some areas where we will see expansions.
I think that one of the things that you said that sort of caught my attention because of my background in manufacturing is that you looking at a nascent rise in the possibilities of manufacturing coming back. So I'm wondering, are you talking about in the new technologies and the more environmentally friendly manufacturing things, new products? Or are you talking about a resurgence in old line products in manufacturing? I was really curious about that.
So maybe Ed will also mention that. So we found in the past several recessions, actually manufacturing, a county or whatever the region with higher manufacturing share got hit harder because they cannot compete globally. But this time it's very different. So I would say the composition of manufacturing renaissance will be different from the past, will be more advanced. So yeah.
But in terms of jobs, there's always, manufacturing has a productivity improvement month after month, year after year, which requires fewer people to do the same amount of work. That can only be offset by product innovation. And I don't think we're seeing huge kinds of product innovation. So manufacturing employment as a share of the US overall employment is going to stay low. And that has huge political implications.
So,
Yeah, and the kind of people who are going to be employed in manufacturing, and you only need to look at the manufacturing that's going on in California. I mean, we think that every manufacturing is completely left California. The opposite is true in terms of output. We're producing more than we've ever produced before, with about 1/3 of the people. And those people who are involved in manufacturing have much higher skills. So these are scientists and engineers and technicians, right? Rosie the riveter, that's gone. Rosie the robotics technician is here. You need fewer Rosies, and they have to be more highly skilled. So a very different composition than the kind of manufacturing that we used to do that employed 30% of the US workforce.
So one thing I would like to add to this, so right now in Phoenix, they are building this semiconductor factory, by TSMC, and they found the difficulty to find an engineer to work for the semiconductor factory. So job training is definitely very important.
Yeah, and it's bringing back apprenticeship programs, and we see that in a number of our manufacturing sponsors. We have a question from over here.
Is there any correlation between the higher cost of living and those people who are technically not employed, because there's a number of people who are unemployed, coming back into the workforce, so that the number of unemployed is going to swell because more people are coming into the workforce because their families need more money? Is there some kind of a correlation there, where the unemployment number is going to be distorted not by the number of people out of work, but by more people coming in looking for work?
Take it. Yeah. We've seen a little bit of this, right? That people have started unretiring as, real wages have gone down, cost of living has gone up. We saw an uptick in labor force participation. We saw an uptick with labor force participation as schools reopened and women came back into the labor force, but it stayed stuck. We're still below the level of labor force participation that we were, right before the pandemic. And so is there more room for it to go up? Yes, but at the same time, once you early retire as a pilot, right, which a lot of, happened a lot in the, people got buyouts, during, the early part of the pandemic, how do you actually get these people to come back, right? And so I think we've lost a permanent segment of our workforce that have retired early, don't need to come back. You have to talk about situations getting pretty dire for these people to want to come back. And even though we've seen high inflation, a lot of people are holding on to 2.75% fixed rate mortgages for the next 30 years that they've refinanced. So even though, rental inflation is high, they're not getting affected by it because their housing payments have stayed stable. They're just getting hit with higher fuel costs and higher food costs. But is that enough on its own to impel people to go back into the labor force? I think we're still going to have a shrunken labor force unless the economic situation gets really dire. And people have to start scrambling to be able to to make ends meet.
So Leo talked about pilots, but kind of more generally, people who were in the labor force and skilled have seen, if they left the labor force in 2020, every year their skills become kind of more dated. So if you're a pilot and you haven't been working for 3 years, you're going to have to go back and do all of your retraining. And sure, you have muscle memory and so on, but this is sort of an expensive, time-consuming process. And I think that's true in many instances. In fact, we had a seminar yesterday at which I was informed that all of my skills in programming COBOL were now obsolete. So skills do obsolesce. But one of the impacts of inflation is that if you're on fixed income, inflation eats away at that fixed income. And I think that speaks really to your question that fixed income retirees now have more incentive to come back in the labor force, even though their skills may have obsolesced somewhat.
And I mean,
Can I add a little bit, because historically macroeconomic forecasting or macroeconomic studies have focused on the demand side. We talk about inflation or jobs, et cetera. It's all demand. What you're hearing is a whole bunch of supply stories. And the most recent issues with its supply make the historical data doubtful about forming a forecast. And so we're in a situation in which there's a lot of guesswork going on about what's going to happen, because we haven't had historical supply problems the way we have now.
But even workers who have, perhaps become obsolete because they haven't had too much training have started coming back with labor force. And you see this, for example, with like Tom Brady on retiring. So there's really a lot of potential that we're going to get, additional workers coming in. That was just a joke. I had to set that up to be able to.
Yeah,
to
but
bring the
did he
Tom
ever
Brady
really
example.
retire?
Exactly.
He gets a kick out of it.
Excuse me.
Okay, we have another question.
We talked about single family housing. What about rental, that rental market? How is that going to be affected?
Well, one of the implications of higher interest rates is that folks are forced out of the purchase market and into the rental market. So it's kind of and rents are 1/3 of the CPI, 30% of the PCE index. So the inflation indices that the Fed looks at are heavily influenced by rents, even though 2/3 of Americans don't rent. And so increasing interest rates actually exacerbates the measured inflation problem, not necessarily the actual impact on most Americans' budgets. But we expect rents to be pressured by these higher interest rates.
The way in which rents moderate is oftentimes households disappearing. And what that means is that two households that were living independently, now become roommates. Or, kids find it too expensive to be able to live in their own apartment, so they go back and live with their parents. And as unemployment goes up and, the cost of living goes up, that's the way that you actually, reduce a lot of the pressure on rents in the short term, is this household dissolution where the demand for apartments goes down simply because people are doubling up again.
But to some extent, the rental pressures that you've seen in some markets, and I'm thinking of Phoenix as a good example of that, that's not sustainable because household budgets are not increasing enough. So if you don't have this doubling up, expect at least the rate of increase of rents to abate quite a bit. And George?
Yes, sir. My question is about sort of the pending Fed pivot macro situation. Because you were talking about the 70s inflation and that whole time, and you have, debt to GDP under 50% at that point. I've seen numbers saying that, we're at 140% debt to GDP right now, or in that range between 130 and 140%. You have, looks like, $1 trillion deficits forever, essentially, right? The spending, government spending isn't going down, and, entitlements, military spending, so on and so forth. And debt to GDP at these levels, and the Fed is hiking into this. They're selling the balance sheet off into this, yields coming up. I mean, how does this shake out? I mean, this is like, I've read people saying that when you have debt to GDP numbers like we have, there's, the potential for sovereign default is real potentially. I mean,
You're talking about federal debt to GDP.
yes, sir.
And
So Ed, you've studied this.
so the thing that you haven't mentioned is the unfunded liabilities for Social Security and Medicare, which adds something like $100 trillion worth to the federal government. And that and the ongoing debt is a form of fiscal child abuse, because the younger people in this audience are going to have to pay huge taxes going forward in order to do the debt service, in order to fund Medicare and Social Security. And I think we have a political system that is incapable of looking forward into the future and taking actions today that would get us into a better future. It's a huge problem for our young people in America.
Until the young people say, we're not going to pay that, and then, Ed, you'll have to come back to work.
It's too hard for them to even to raise taxes in a meaningful way, right? Because it's so dysfunctional. So they just turn the money printer back on, right? This is obviously what's going to happen. They're going to turn the money printer back on. They're going to have to do this. They can't let yields, fly high with $31 trillion in debt and entitlement spending and all of these military budgets and everything else coming down the pipe. I mean,
but you're right. The federal government is going to have a lot more debt service to do with these higher interest rates, which leaves a whole lot less. It's going to cause a bigger deficit and possibly more borrowing. And I just think it's it's abuse of the young people. I think young people have to wake up and argue that this stuff has to stop. Otherwise, their future is very much in danger.
Okay, and let's see in the time we have left, if anything come in over Slido. We have,
Yeah, I think this is for you. Could you talk about the perspective of the tech sector in California?
of the tech sector?
Yeah.
So, one of the things that we've talked about is, and this goes to the discussion that we've had about manufacturing, but also about retail and about other services. One of our colleagues, Uday Kudikar, has studied this on the service sector, that there is really a move to try and increase labor productivity. And if you think about it, kind of in terms of just a simple example, prior to 2020, if you went into a restaurant and you saw a QR code, you go, okay, I don't know what that is, but it's cute. Now you go into a restaurant, you see, you pull out your phone, you get the menu, you order. That's labor saving productivity. In the food service industry, in retail, and in manufacturing, and all throughout the economy, on the part of the business community, there's a real desire to find technologies that are labor saving, especially with the labor shortage, the tight labor markets we have today, and the increasing cost of labor. What that means is that those who develop that technology have a chance to really grab that brass ring, right? And those who are best positioned, as evidenced by the venture capital expenditure, are disproportionately here in California. So I think that we're going to see the tech sector continue to be one of the driving forces of growth in California. That's not going away, but it's not necessarily going to be, in fact, it's probably not going to be, is there a more efficient way that we can share pictures with our family or make political statements online? Is going to be more labor-saving technology throughout industry. And I mean, we're going to see it here in battery development. We're going to see it in manufacturing. We're going to see it in clean tech and green tech and med tech. The increase in inflation in medical costs that Leo spoke to, that really pushes the health sciences sector to innovate. And California is a very robust health sciences tech sector, including the here at UCLA, and we have accelerators and innovation labs for that. So do we have any other Slido questions?
No, that's it. But we have a question over there.
Okay, so last question, please.
Yeah, I have a number of things. I've been sort of following business economic and business forecasting since 1980. And the thing that strikes me is that we are, I think, in a brave new world. I mean, at least in my 30 years, never had an experience like COVID. And I guess just as a conceptual question, I would ask the panel, if to the extent they can comment, how they see COVID perhaps distorting, the historical, numerical and quantitative data on which we use to forecast and guess, what's going to be happening in the next 12 to 18 months. So that's one part of it. And then the other part of it, perhaps if there's time to comment on what the effect might be of raising the US corporate tax rate back up above the rest of the world's in terms of capital flowing in here and the manufacturing renaissance. And then lastly, perhaps if there's a thought on doubling the size of IRS, does that simply transfer growth and economic activity from the private sector to the public, or does it have a more nefarious effect? Thank you.
Okay, I think we're going to punt on your middle question. Quick answer to your last question. Some research that's been done here at UCLA by one of our colleagues in the law school shows that the increase in the IRS is actually cash positive, not cash negative. And then the data question, I'm going to turn to Ed.
About can you rely on the COVID data? So if you look at the 70s, which I was suggesting, that was a demand-driven inflation period. And the Fed had the need to eliminate that by creating unemployment. Now we have a supply, very much a supply-oriented inflation, at least a lot of talk about it being supply. So the expectation, the hope is if we could relieve the supply problems, the inflation will go away. And it kind of looks like the last couple of months did that. But what you're raising is the point that we don't have any historical tests of supply corrections and their impact on inflation. So we're still, I was still too much relying on the 70s, which was a demand-driven inflation problem.
So let me make a last comment on that before we go to break and then to our outstanding keynotes. And that is, we're in our 70th year as a research institute, and one of the driving forces of the creation of the Anderson forecast in 1952 was a sense that the data that we had during the Great Depression and during the influenza pandemic was insufficient to make good macroeconomic policy. It wasn't just at UCLA, there was the Coles Foundation and things happening all across the country. But that was sort of being disconcerted about the kind of data we had, and we might be looking at that going forward. But that was the part of the impetus to start our organization 7 decades ago. And with that, we're going to take a 10-minute break and then start our keynote discussion with two eminent thinkers and doers in the climate change space. So it is now 10 o'clock. We'll see you at 10:10. It's time to stretch our legs and then we'll get going again. Welcome back. And now we're going to turn to the second part of our program where we're going to try and drill down on a third aspect of uncertainty that affects all of our business decisions, and that is climate change. And we are really fortunate today that we have two keynotes with us, two individuals who have made a major impact on climate change adaptation, mitigation, and thought throughout their careers. Both came to this calling by looking at climate, the impact of climate change, and saying in kind of different spaces. With Terry, it was the ocean, and with Andy, it was the San Bernardino Mountains, saying, what can I do? And it turns out that the answer for each was a lot. And so we are fortunate to have them here. I'm going to do a brief introduction. You're not going to think it's a brief introduction, but you should read their bios. They're very extensive. But just to let you know a little bit about our two keynotes. Terry Tamminen in 1983 founded Santa Monica Baykeepers, now known as Santa Monica Waterkeeper, and co-founded additional waterkeeper programs in 5 California watersheds. Later served as his executive director of the Environmental Now Foundation and co-founded Frank G. Wells Environmental Law Clinic here at UCLA. He's held important roles in California state government and was the architect of California's landmark Global Warming Solutions Act of 2005 and Hydrogen Highway Network, and the Million Solar Roofs Initiative. In 2007, he founded the nonprofit organization Seventh Generation Advisors. CGA's strategy is to create a bottom-up approach rather than waiting for policy from the top. In 2016, he was appointed CEO of the Leonardo DiCaprio Foundation. And in addition to serving as president of 7GA in 2022, was appointed president and CEO of AltC at the Port of Los Angeles. He's an accomplished author, including books Watercolors, How J.J. Whale Saved the U.S., Cracking the Carbon Code, The Keys to Sustainable Profits in the New Economy, and Lives Per Gallon, The True Cost of Our Oil Addiction. In 2009, Terry was named Eco Baron in the Pulitzer Prize-winning journalist Edward Hume's book, Eco Barons. So that's Terry. Andy, no less illustrious, is a practical visionary who began planting trees to rehabilitate smog and fire-damaged Los Angeles area forests when he was 15 years old. And as I've told Andy many times, at 15, I had no such awareness. There were other things that were interested me besides trees. But we're not going to go into that because we're on Andy's bio. At 18, he founded Tree People and has served as president until 2019 when he retired from Tree People and joined Accelerated Resilience LA as project executive, taking on new challenges as a guiding light for urban climate resilience. And for those of you who don't know Tree People, you should look at it. They have done amazing work over all of the decades that Andy has led it, and continue with the inspiration that he gave them. So for 5 decades or more, he has worked to create a greener future for Los Angeles by inspiring people along with their local governments to plant and care for trees and harvest and conserve the rain. Since its founding, Tree People volunteers have been responsible for planting more than 2 million trees and counting. And its environmental education program reaches more than 200,000 students per year, with millions of children touched each decade. Andy has also served as a consultant to the city of Los Angeles and program planner and public engagement and education facilitator. Beyond LA, Andy worked with cities such as Melbourne, and we're going to get to that, and Hong Kong to help people plan for climate resilience and adaptation. In the wake of the devastation from the 2018 fires in Southern California, Andy crafted a collaboration between Tree People, the Rockefeller Foundation, 100 Resilient Cities program, and the Conrad Hilton Foundation, and the Society of American Foresters and American Society of Landscape Architects have bestowed on Andy the well-deserved titles of Forester and Landscape Architect. Okay, so those were the short intros. And so let's get to what we're here for. And Terry, I want to talk about the macro picture. And when we were prepping for this, you were talking about what you studied in terms of the port of Venice, Italy, and sea level rise. And of course, for California, our ports are strategically important, but also for the US. And maybe you can talk about that and what are we facing? What are the issues? And kind of what are the implications of all of that?
Wow. How long do we have for this session?
24 hours.
Let me start by saying thanks for inviting me. I've always been a big fan of the work of the Anderson School and of the forecast that has gotten it right so many more times than it maybe have gotten it wrong. So it's been that guiding light. So thank you for inviting me. And of course, this is my environmental hero. This guy, as you said, from the age of 15, I can't even claim that. It took me a while of bouncing around in different jobs before I kind of realized the environment was my passion. But Andy, I have always just admired for his ability to turn ideas into action. And someday he should tell you the story he told me about one night getting his daughter's school budget and saying, why are they spending all this much on pavement? And remember that story, and that led you to the whole trees initiative. So
$200 million.
Yep. So anyway, just follow this guy. That's the answer to all of this. But to answer your question, I think one of the things I want to emphasize today as we talk is the fact that, especially as we're talking about economic forecast, is that we've got to start building adaptation planning into our thinking. in terms of infrastructure, in terms of economic planning, and considering worst case scenarios. And that's where the Venice example comes in. You know, we're seeing stories that the Thwaites Glacier and the Greenland ice mass might literally slide into the ocean in the next 10, 15, 20, 30 years. And if so, that's not just slow melting and slow sea level rise. A lot of sea level rise today and in the last 50 years has been the result of a warming planet, and warmer water expands. It's not so much that there's more water somehow in the ocean. So that's why it's been gradual. But even that has caused the city of Miami Beach, as an example, to spend $500 million to raise the roads and put in pumps for dry weather flooding because of this sea level rise that already most people can't even see. But imagine if, in fact, these glaciers melt and at a faster rate and slide into the ocean. The most catastrophic predictions are that literally in weeks, years, or for that matter, it could literally be overnight if they literally slid into the ocean, that you'd have sea level rise of 3 to 10 feet. And that would obviously be devastating to our coastal infrastructure, whether it's ports, whether it's the sewage treatment plants, the power plants that are located along our coast, not to mention the value of real estate and so on and so forth. The Venice example you mentioned is because of just this slow sea level rise. You've probably seen in the news every year, there's more flooding in St. Mark's Square. There's more flooding throughout the city that they can't handle. And as a result, the port, which you don't see in the news, has also resulted in various flooding, which at times then the ships can't get into the port. And so now I was told by one of the port authorities there recently that many of the shipping companies are no longer planning to bring ships into that port because it's unreliable. So they're losing business because of the unreliability of that port. And that's the kind of thing that's going to happen slowly with sea level rise and with other environmental and climate change implications, or very fast. And we need to be prepared for either.
So how important is the port of Venice to the economy of the city and region?
It's actually, I mean, most people would assume it's tourism. It's the
Sure.
biggest economic driver to Venice, and it's becoming more important, or would have been. Trieste is now kind of taking over a lot of this because the ports in Ukraine have been closed because of the war. And so those ports in the upper Adriatic there have become even more important for getting goods into Central Europe or out of Central and Eastern Europe.
So that's a real tale for California and the California ports. Are we in similar danger here with, say, the ports of Los Angeles and Long Beach?
Well, I can tell you both ports, and now, as you mentioned, I'm working on a project called Alta Sea in the Port of Los Angeles, which is renovating some 100-year-old warehouses into a modern incubator for the blue economy, for aquaculture and underwater robotics and wave energy and so forth. And so I'm in the port almost every day, and I talk to a lot of officials there. And for years now, they've been doing planning for this sea level rise, for the fact that, you know, even if the seas rise a small amount, that changes. If you've been in the port and you've seen all the automation of cranes and things that are moving containers around and so forth, that's all very precise. And you know, it's funny, we talked about how more earlier in the panel, you were talking about how automation has led to more efficiency, but actually old-time stevedores and cranes and palletized shipping is something that would have been much more flexible to be able to adjust to changes in water heights or water conditions and so forth, whereas the very automated and precise equipment is much less tolerant of those changes. So it's interesting that over time, we may have to actually backtrack to some more manual labor to deal with some of these things, at least episodically, at least when we have more intense storms and sea level rise and flooding events.
So Andy, I said we were going to come back to Melbourne, so Australia went through a drought, and this was something that you looked at and studied, and the impact on their economy and what they did. In the Western U.S., we're in a multi-year drought, maybe less so in parts of California, but certainly in the Western U.S. Can you tell us about what you learned from Australia and what the applicability is to the California economy?
Yeah, first of all, our climate are very similar in terms of Southern California, Mediterranean climate, and much of the populated parts of Australia around their coasts. The population is probably the closest in culture, in lifestyle, fashion, consumerism to us. So it's a near perfect match. Their Hollywood and our Hollywood collaborate really, really closely. And so I was looking at that because of our similarities and because how they responded so profoundly to the same kind of threats that we have. But they, at the turn of the century, actually starting in 1999, they went into a severe drought. And it was called the Millennium Drought, and it lasted close to 12 years. They did extraordinary things to survive it. And I found that a really potent transferable model for us in terms of how we could quickly adapt. I brought some of the coordinators from the Australian government here. In fact, we spoke here at UCLA together. And when we turned up the heat on getting aggressive with this for California in our last drought, 2014, 2015. And we brought one of the leaders here and had him for brunch on a Sunday with leaders from around the state, including Felicia Marcus representing the governor. She was the head of the state water board, and she was in charge of looking at the drought, and they were wondering if and when they should declare it. One of the first things I asked the Australian coordinator is, when in the 10-year drought did you realize that you were going to be in the middle of a 10-year drought and take appropriate action to handle the massive emergency? And he said it was about year 4 or 5. So what they did there that so impressed me is, and again, there's cities, Melbourne, 4 million people, Los Angeles, 4 million people, Sydney, even bigger, built very much the same way. Similar to us, it also continued raining. And as it has here, and I've got to make sure I don't leave this, this is really critical. Los Angeles has had roughly 20% above average rainfall this year. I am not saying you shouldn't conserve. You darn well need to conserve a lot, but it rained here and it rained a lot. And the whole story I'm about to tell you is about how much water we have here that we are throwing away. The economic opportunity to build an industry, build an economy around harvesting the rainwater that's here, tens of thousands of jobs that could be here like they did there. So what they noticed is it was raining. They were getting their water from their dams like we do from damming rivers, where in areas where the rainfall was not as high, just like California. And by the way, climate forecasts for water in California, you probably all know it, you've heard it. Increased heat, lower rainfall. Increased heat is melting the traditional storage that we had, the snowpack in the Sierras. Less rainfall. The soils are drying, less when the snow does melt, less water is hitting the rivers, and being less water is available to be diverted here. But the long range forecast for California includes that Los Angeles will get the same amount, if not more, water in this severe climate regime. This is important. So what the Australians did was take an old tradition of rain tanks that they had on farms, cisterns and tanks, and they brought them into the city. And so there was a little bit more social familiarity with that tradition, but they blew them out and took tanks that were meant for farms. The governments invested in manufacturing urban cisterns, inexpensive cisterns, and incentivizing them so people could install them. And they did. So cistern, tank, we're talking about not a 50-gallon rain thimble, but we're talking about 1,000, 2,000, 5,000, 10,000 gallon tanks. You could make them linear so they fit in a fence line. You can make them attractive so that they're part of the landscape, and that's what they did. And people adopted these because everyone who got them had water. Now, they radically changed their lifestyle as they got their tanks and saw they had water. Suddenly they had a water bank account visible for them rather than the one that was coming through the tap that they couldn't see. And they changed their behaviors. They conserved more and more water and got more and more secure. This saved the country. So at year 5, not only did they start incentivizing installing rain tanks, but they also, of course, invested in desal. Just like California, all their cities in the whole country are on the coast. And they invested a lot. What happened, though, is the massive install of tanks and cisterns. And let me give you an example of what's exactly possible here right now. They have a home supply store, just like Home Depot. It's called Bunnings Warehouse. You wouldn't know you weren't in one. But you could go online, look at a map, dial into your house on the map. Their little app for their store would look at your square footage of your roof, calculate what size tank you needed, calculate the rebate the government was giving you, and you would just, if you wanted, you could just click, I want that, and the tank would be delivered and installed to your house. That was just one example, but the result of aggressive investment in this new water supply, within 5 years, 40% of the homes in Melbourne, same size as LA, 40% installed rain tanks. 40% in Sydney, bigger than LA. 50% of the homes in Brisbane and Adelaide installed tanks. It built a whole new water supply. When the drought was over, nobody was buying water from the desal plants. They didn't need it. The Sydney one was mothballed and sold. The rest of them are being held for major emergencies. A couple of the important things that happened. Their water systems, just like all of ours, were financed by water sales. So Metropolitan Water District, our wholesaler, Department of Water and Power, and all others are dependent right now on our buying water to fund themselves. They are in a highly conflicted position to really advance conservation and develop local supply. What the Australian federal government did, and then working with states, was say to the water agencies, we're going to make you whole, but we got to get these tanks out there. So don't worry about your finances and your income. We're going to handle it for you. We're going to switch it to a tax-based system because water is now forever scarce, and it is. But in doing that, then the water agencies got to be rewarded and get on board and help make this happen. So home industries, big industries were created. The company's largest steel firm went into making cisterns, plastic ones where they were appropriate. And as I said, it saved the country. I brought delegations of California leaders to see it, including Felicia Marcus, a bunch of teams from the state, the city, and we have still not adopted the kinds of things that are right within reach that we could be doing. But when you think about what we can be manufacturing tanks locally, installing them. When you look at the climate scenario for Los Angeles, what we have, as you already sort of know, is extremes. We've got drought, we have flooding. Our flood control system is not set up for the magnitude of rain, of severe rains that we're expecting. Our water supply system isn't set up that way. But in this new world, I was listening in your last session, it's like, what is next in the economy? It's a shift from being an extractive-based economy that's trying to mine resources and throw them away, instead of working on regenerative. And an example here is, imagine what could happen if we retrofitted Los Angeles. The economic impact of hiring as many as, I calculated this back what moved me into water, interestingly enough, was the Rodney King unrest. I'm a co-founder of the LA Conservation Corps along with Mickey Cantor. We were struggling to create jobs for young people, chronically unemployed young people. And after the unrest, the sociologists that studied Los Angeles said we needed to create 50,000 jobs for chronically unemployed urban youth in LA to mitigate the causes of the violence. I knew Peter Uberoth because we tried to work together during the Olympics as we were working to plant 1 million trees for the Olympics. And he was put in charge of Rebuild LA. And I talked to him about what we needed to do. And he said, we got to rebuild. You can decorate, you can plant your trees to decorate the city afterwards. I said, you don't get it. This is not landscaping for decoration. It is for jobs and all that. And I calculated that the 50,000 jobs would cost $500 million. I think actually I turned to you, Jerry, at that time. And so what would it take to generate 50,000 jobs? And I started looking for that $500 million. LA tried to get a emergency block grant and it failed. I brought the first federal money into LA, just $13 million, because I had a connection with the Bush White House at that point. They made my wife and I the 135th point of light. So it gave us access to call, and we got a small grant. That $13 million did create 400 Forest Service jobs where 400 people were bused from South LA to the forest for 3 months, and then the jobs were gone. You know, it was not sustainability. It was not regeneration, except about 30 of the people retained jobs in the Forest Service. The rest of that was, it just wasn't a sign of health. But I was shocked to find that $500 million did show up in LA. And it was the Army Corps of Engineers with a plan to raise the walls of the LA River, because they discovered that in the floods of 1978, early onset severe weather in LA, the river rose to its bank and the rain stopped just as it was depositing debris at the top of the levees down towards Long Beach. Another ½ inch of rain, it would have flooded from downtown LA to the harbor. So they had an emergency project to raise the walls of the river to more efficiently get rid of the rainfall. And I'm going, this is crazy. We need that water. We can't just be doing that. And I challenged the Corps to look at investing that in urban watershed management, including a high-tech system of tanks that could monitor and respond to water filling the tanks and release it before a storm, in between waves of the flood. I designed that system. We've now built a pilot with LA Flood Control District, LA Department of Water and Power, LA Sanitation. Our challenge is all these agencies are not working together. There is no protocol for the people who bring in water. LA spends about $1.5 billion a year to import water. The county spends about $1.5 billion to throw away the rainfall. We did a study, the county confirmed it, DWP confirmed it. Rainfall represents half the water we need, and we throw almost all of it away.
So
today.
In that regard, I know that you have those tanks that you talked about in Australia at your house. How much water have you collected in the last rain?
So I repurposed some of the Jersey barriers, plastic road barriers that you might see them. They're usually orange and white. I went to a local manufacturer, got green ones, and put in a 1,000-gallon tank, just 3 foot high along the front of my lawn. So it's 1,000 gallons. When it rains 1.5 inches, I collect 1,000 gallons from my garage roof. This
Just your garage roof?
Just my garage roof, 1.5 inches of rain. The overflow I send into, I took out the lawn, sheet mulched it. It's now a deep absorbent sponge. And so looking at, and all of you can go to the LA County Flood Control live rain gauge site and see the rain gauge near your house. There's over 100 in the area. I live in Venice. It rained an inch and a half since October. Some areas of Los Angeles got close to 20 inches this year since October. On my house, if I had connected the downspouts from my whole house and not just my garage, it rained, I had capturable from the roof 26,500 gallons of water. And I've been wanting a 20,000 gallon tank. But extrapolating, if you say LA got 12 inches of rainfall and the average was higher, for every inch of rain that falls on Los Angeles, it's 7.6 billion gallons. 3.8 billion gallons is capturable. So on the rooftops of the city of Los Angeles, capturable rainfall generated 114,000 gallons of capturable, drinkable, usable water for every one of the 4 million people in LA this year in a drought. That's an industry, it's a change we need to make, and we need to use that thinking, not just for LA, but this is the kind of thinking, if we start looking instead of it extracting, but conserving resources, engaging the public, it's a basis for a regenerative economy and investment, hopefully now and soon, that'll be creating jobs and hope and safety. Most importantly, safety. I want to say, and then I'll stop because I will fill the time. We were really fortunate to be able to get the 3 major agencies to agree to collaboration: flood control, water supply, sanitation. They're all dealing with the water, and they have no coordination facility, period. And that's insane. We know how to do that stuff. But I got the chiefs to agree to work together and not fight. Each agency brought 30 of their top people and their chief and spent a day doing a design charrette with 100 designers, facilitated by one of the local engineering companies. We came up with this design for manufacturing cisterns that would be remote controlled, available for the homeowner to control from their phone, see how much water they had, but the agencies all sharing a dashboard where they could all have access to that water, to use it for water supply, use it to release before a storm for flood protection, use it to clean the streets by pumping the water into the street, small amount to clean LA streets, send it a small enough amount to go to the treatment plant. We've been building what's called a low flow diversion system in LA, so water can go to the treatment plant, but it's too late when there's a big storm. But when you could send the water there before, we capture the water, we send no pollution to the ocean. All these things are being built. The missing piece was this networked nimble tank. And as I said, we built it, but getting them to work together on a permanent basis really is the goal. And I'll just finish with, we know, how many of you've heard of the Emergency Operations Center, Emergency Command Center? Every city has them. It's a best practice that everyone knows around the world. You get everybody together in the room, diverse agencies, and you're getting real-time input. You're adaptively managing, you're sharing resources. You've built a system of mutual aid agreements to suspend worry about when you're going to get reimbursed. It's just all there set up ahead of time, and people collaborate. I pose to you the reality to step out of denial. And when you look at the social, human, economic impact that climate is hitting us all the time, we need to move into a local, regional, statewide, federal system of climate emergency centers that can allow us to invest well, allow us to respond well. And we need the policies, of course, to support this kind of rapid adaptation. And I'll get into why we created Accelerate Resilience LA in another question.
Yeah, so
And
I mean,
Andy,
sorry.
three quick reactions to that. Number one, my family moved to Australia when I was a kid. So in 1968, I lived in a house in Brisbane that was on stilts because of periodic flooding. It was just the way they were built, with I don't know if it was 1,000, it was probably more than that. It was a big corrugated steel water tank.
Probably 5.
And so we're now going all the way back to the future, especially in Australia. Second thing I want to emphasize is this point about policy, not just coordination, but policy reform. And it happened with energy as well. So the utilities are in the business of selling electricity, so they didn't really want to see us conserve that much or put solar on our rooftops and basically take away their business. So the Public Utilities Commission said, all right, let's decouple how much profit you make from how much you sell. And therefore, again, as you said, we'll make you whole. Now, the utilities still fight against a lot of distributed energy, but for the same reasons we need distributed water, we need distributed energy, especially with climate change. We've already seen just pressure on the grid with hotter summers and rolling blackouts and that kind of thing. We need the resilience and the extra clean energy on all these rooftops. And I will say that part of our Million Solar Roofs initiative in the Schwarzenegger administration, 10 years later, we originally wanted 1 million rooftops. We got it. We thought that would generate about 3 gigawatts of clean energy. It ended up, the total generation is 8 gigawatts. So sometimes when you have good policies, the policies matter, but it's those little hidden tricks that or traps that you have to think about to try to unlock the potential of these ideas. The last thing I'll mention in response to what you were saying is, when you talk about water and how we're wasting it, we dump from Los Angeles County alone over 1 billion gallons of water a day from our sewage treatment plants into the Pacific Ocean. We spend a lot of water to clean it, pump it 7 miles offshore and throw it away. There's enough hydrogen in that water that if you extracted it, you could power the entire United States transportation fleet. Now, obviously, you wouldn't try to do that just from Los Angeles, but it shows you that every city, cash-strapped city that has a sewage treatment plant could go into the business of producing hydrogen from its wastewater, sell that to those of us that need it in our vehicles or for energy generation. And in California, we do what's called curtailing renewable energy. We now have so much wind in particular that blows at night when you don't need it, even solar too much at some times of the day, that it ends up getting either sold to neighboring states. Literally, we pay, California Independent System Operator pays neighboring states to take it, or it gets literally zapped into the ground. You could take that curtailed renewable and that wastewater, electrolyze the wastewater to extract the hydrogen and use that to power our vehicles and energy grid.
Let me build on that. There's a UCLA theme that runs through this. So UCLA had its first Millennium Grand Challenge with the question of, can we get to 100% local water supply in LA? Now, working with 3 people, we got Department of Water and Power to do a rainwater capture master plan, which they did. They spent $2 million, 2 years. One of the greater national engineering firms did the study, showed that yes, rainfall represents roughly half of Los Angeles needs. UCLA stood on our shoulders from that and said, what would it take to get to 100%? And it included, we could do it. 100% local supply in LA. And this is all about jobs. It is all about local investment. Capture the rain. To Terry's point, collect, we already collect, recycle the wastewater, which can be served safely to everyone in that process that you're talking about. Also clean up the San Fernando Valley aquifer and hold our water use to 80 gallons per person per day, which we reached in the last drought. That gets us to 100% local supply. An investment, huge investment in workforce in Los Angeles. And so this is all policy. It's come out of this, partly this school, this campus. It's there within reach, but nobody's incentivized to make the leap.
Perhaps our next mayor.
Yeah, so let's pursue that a bit. What we're talking about are huge investments in the ports, in rainwater capture, in energy generation that would make Los Angeles or California much more resilient, create jobs, and change the trajectory of the California economy. But that involves a lot of investment today, an enormous amount of investment today. The returns to that investment are sometime in the future, sometimes long in the future. And how do you get people to focus on the rate of return when the rate of return today is, if you're looking at, say, a 5-year horizon, it may be very small. But if you're looking at a 20-year horizon, it may be very large. And so isn't that a problem of doing it today rather than waiting until people see it's a crisis and an emergency?
Well, I think today they can see it's a crisis and an emergency. I
I'm
think
not-
that's take advantage of the headlines. I think, you just take that example I gave from Miami Beach. Now, remember, this is not the city of Miami. This is Miami Beach, which is tiny. And they had to come up with $500 million. And one of the crises that made the people in that region realize that it was time to do this was you can't get a 30-year mortgage on a home or a condo in Miami Beach or much of Miami today because of sea level rise. You can't get insurance in coastal Florida anywhere for housing or commercial real estate that's close to the coast, much like we have an earthquake authority for insurance here because no private insurance would take on that risk. They have a similar authority in Florida because of these greater risks of greater storms, more flooding, et cetera, et cetera. So when business starts to see that it's being pinched, then they raise their hand to our leaders in Sacramento or in the city and say it's time to do something about this. And then hopefully even business leaders will support these changes. But you need visionary leaders that are willing to adopt the kind of work that you're doing, that Andy's doing, that we've seen in other places that has worked, and recognize that this is 20 years ago, you could talk about, well, climate change is slow, it's in the future, even the worst case scenario is in the future. We don't have any more time to waste. And as I mentioned earlier, I think a lot of this now is going to be about adaptation, not just mitigating our way out of these respective problems. So I think it's up to visionary leaders, and that's why I only half jokingly say our next mayor has got to make this an absolute signature of his or her administration, because we've run out of time to do this in reverse. It's got to be in advance.
If I could build on that, in 2017, the head of the resources agency for the state of California, they're in charge of forestry, water, fire. They're a big agency, but they're not a business. The head of that agency held a meeting in Sacramento and invited 200 state leaders, electeds and agency heads. And he invited me to be one of the speakers, along with Mark Gold from here. And he didn't tell us why, but he gathered everyone together and he said, ladies and gentlemen, the reason why you're here is because the state of California can no longer guarantee the safety of the people. Climate change has outstripped the ability of our agencies to respond and protect people in emergencies. That's all I have to say. That is the state of our state right now. And as evidence of that, the following week, we had Hurricane Hugo, which outstripped all governmental strategies, services. Neighbors were left alone to help neighbors, and they did. The week after that, a hurricane in Florida. Week after that, another one back in the Gulf, and then there were 3 concurrent hurricanes, never seen before in history. And then it swung to California, and we had the Santa Rosa fire. 5,000 homes burnt in a matter of 2 hours. People had no warning when they called the fire department because they saw flame, they smelled smoke. Fire department said, we don't have it. We don't have any record of it yet. But it was moving at 50 miles an hour, leaping through the city before people could respond. Bottom line was people had 3 minutes to get out and try to save a neighbor or maybe be saved by a neighbor. That's where he left it. The implications of that, our policy, are also building collaboration at the neighborhood scale. If people died in Santa Rosa because they didn't know their neighbors. Think about this, and we are in the same position living here. If you haven't had a conversation with your neighbor about if a fire happens, if a quake happens, and I'm awake, and I ring your doorbell and you don't respond, but I know you're home, you don't have time to prevaricate and wonder whether someone's going to be on the other side of the door with a gun. if you've had the conversation, you may save their life or they may save your life. They only had 2 or 3 minutes. That is our reality today. This is uncomfortable, but it is true, it is real, and we're seeing it repeat over and over again. The insanity is that our politics today is driving us further apart. The point about resilience, not just climate resilience, but climate resilience and all resilience, is we're in this together. And anything that's driving us apart because of our differences risks death to your family, to your loved ones. There's so much available if we can collaborate and cooperate. And we really need to see ways of business, which serves business best, mostly, to have people be happy, healthy people and not be driven by fear and driving each other apart.
And by the way, to that point, you know, I think modern technology can help in that regard. Like we've got a neighborhood, I don't know what it's called, a Facebook page essentially, but it's an app that's on all of our phones where we're connected with our neighbors. So even the ones where, look, we're busy, we work long hours, maybe we don't see them, they're traveling, we're traveling, we kind of know who they are, but we can still all be in constant touch. Hey, have you seen this? Oh, did you know about that? Oh, you know, let's look out for each other on this issue or that issue. So modern technology can help us with that.
Well, totally, and it has a huge role to play, and we can fill that space because it's not major innovation to help make that happen. I forgot your name already, but Remy. So Remy said hello to me at the food outside and reminded me that I and my team had given her oak trees about 20 years ago, which she planted around her home in Malibu, and thanked me for saving her house. So oak technology includes our native oak tree was designed for this environment. It stops fire. And she's living testimony that her neighbors' homes, mostly all of them, were burnt
Those
in the Woolsey fire.
Yeah.
Oak fire cannot make it through oak trees. They're designed for this. And they're our shelter, but they're also our water supply. And back to the ports and other issues of sea level rise, some of the sea level rise is from us shedding water all around the world. Water that was held in the ground, was held for moisture, is now leaving urbanized areas in ever greater numbers. Oak trees are water capture devices. And again, Remy knows it. But we calculated using good science, I had the Forest Service Research Lab calculate the liquid storage volume of a local coast live oak, our native tree. It looks like, you know, you're in dry hills all over the state, but no, 100-foot canopy oak creates a tank underneath it in the soil as it grows. That tank storage holds 120,000 gallons in a 12-inch flash flood. Captures it, treats it, and then slowly releases it to the aquifer, our water supply. So we can do this and mimic it. Sorry, go ahead.
So Terry said something, and I guess you did also, Andy, and unfortunately, you know, Terry, your first question was, how much time do we have?
Yeah.
We could go on for a very long time, but we've just started, and we're closing in on this. But so the question that I want to ask both of you is, you've talked about this, about what we could do to change the trajectory for adaptation, things that will have a positive impact on the growth and prosperity and wealth of the California economy. But California is trying to lead the way. In fits and starts maybe, but trying to lead the way. But California is large, but we have many other states. And Terry, you're talking about Miami Beach, but Miami Beach, as you said, is very small in a big state where you can't even talk about climate change.
You're not allowed to.
And you have countries that are relatively poor countries that are saying, yes, but we're relatively poor. And so if you'll excuse the metaphor, is California just spitting in the ocean and not really going to be able to change things, but doing what's right because it's Right.
No, I think what we do matters because we're the 5th largest economy on the planet. So for example, when we kicked off our Million Solar Roofs initiative, the installed cost of solar was about $5 or $6 a watt. Today it's $1 a watt. And that's not just because of our initiative and getting, millions of rooftops and so forth, but that's definitely part of it. We drove that economy, not just in terms of more panel production and even imports from China or whatever, but the balance of system, the labor that has to go on the roof and put that on the roof, the electrician, the laborer, the framing, the electrical work, et cetera, drove competition, which by the way, during the recession of 2008, 9, 10, that's when our Million Solar Roofs initiative really kicked in. And a lot of people in the building trades were able to move to that particular industry and get jobs. So we know that what we do matters. Obviously with electric cars, we're going to be bringing down the cost of that for the whole world because of our market as we accelerate the use and adoption of that. So I think we can prove over and over again that what California does matters. Since I left government, I've traveled all over the world working with the UN, with R20, C40. And the number one thing everybody says is, oh, how did California do it? How did California do it? And people are hungry for this kind of example and leadership at scale. The last thing I'll say on it is we've also demonstrated that you can do this in a bipartisan way. We've had Democratic governors and Republican governors now in the last 15, 20 years that have all followed the same playbook, maybe for different reasons and different levels, depending on the economics of the time. But we've shown that this can be a nonpartisan issue.
Similar, California exports our lifestyle to the world, and Southern California, especially Hollywood, we still drive that. And so it behooves us economically to take the advantage, morally to take the advantage, because people follow what they see here. And the threats are incredibly real, as well are the solutions. Terry mentioned that we're the 5th largest, California is the 5th largest economy in the world. We know that, we're strong. By the way, relative to that, the largest single use of electricity in the state of California is what? It's to pump water. 1/3 of the water into Los Angeles. We extended 3 rivers into LA, the Sacramento, the Colorado, the Owens. Just pumping the Sacramento River over the Tehachapi's into LA is the largest single use of electricity in the state of California. That is money to pay for that electricity that's going to oil companies. That money, and we don't need that water, right? That's when we have half the water we need. Imagine if we invested that money in our people and our young people in managing a local water supply that will help us fight fires, help us prevent floods, and share that model with the world. Hopefully we'll get plenty of people. It's not that big of an investment to make that change. Manufacturing cisterns locally. Imagine if Homeboy Industries started manufacturing tanks and installing them. That sort of image of putting people to work with being the heroes to save us from this, that's within reach. So I invite you to dream.
Yeah, so that's a really nice high note to end on this. I wish we could just order in lunch and keep going, but we have another panel coming up, a panel by Impact at Anderson to drill down now from this and doing business in an era of climate change. So please join me in thanking our distinguished keynotes.
Thank you.
And our distinguished moderator.
Yeah. Thanks for the vision of having us, Jerry.
Thanks.
So if the next panelists will come up and quickly get your mics on, we can get going in the next panel. Yeah, it's right here. You have a mic? Okay, let me get the chair. And here's another.
That's mine. Which one is mine? I just
Oh, and the other one, I guess, is mine. Okay, do you have everything? You all set?
One, two, three?
Yes.
Yes, wonderful. Well, thank you very much. That was a very inspiring panel. I'm definitely ready to have my own barrel for my home, just thinking about it. So we are, kind of moving on from what can government do, what can, kind of the community do, to what can business do about climate change. What's the state of corporate sustainability? What is currently done? What is going to happen in next couple of years in terms of new regulations and in terms of change? We know we need, something needs to happen. 30% of carbon emissions come from firms, from corporations in the United States, direct and indirect emissions. So that's a lot. So what do we know and where are we going? What will business have to do in the next couple of years? This is a forecast, kind of event. So we're going to try to be forecasting. So my name is Maggie Delmas. I'm a professor at UCLA at the Anderson School and the Institute of the Environment and Sustainability. I'm also the faculty director of the Center for Impact at Anderson. And one of the things we're doing is developing measures of corporate sustainability. We'll talk about this in a moment. First, I want to introduce our wonderful panelists. I will start with Kelly Clark, who works currently at the Center for Impact as the stakeholder engagement and ESG specialist. She's in the process of getting her doctorate in environmental science and engineering at UCLA. And she's a lawyer, and she has also been working for waterkeepers, so also specialist of water. Henry Friedman is a professor of accounting at the UCLA Anderson School of Management. His research is about the role of information in the area of firm behavior and market behavior. He has done a lot of work on lobbying and also on sustainability, on ESG particularly. In addition to all of his publications, is also teaching a class on ESG, environmental, social, and governance. So just advertisement for those interested here. Jacob Atala is the Vice President of Sustainability at KB Home. He's a trained architect, and has been in his role for a long time. He's a veteran of sustainability, I would say, and has participated with KB Home in many of their innovations related to new design types of homes that could be, for example, evolving as you grow, as your family grows, and kind of modular homes, basically, but also in terms of setting standards for energy efficiency and water efficiency and net zero communities. So we do have really three amazing specialists here to talk about the state of corporate sustainability and what's going on with climate change strategies with this firm. So I just wanted very briefly, if I can, show you a couple of slides. Is it possible? Yes. Okay. So one thing is, when we talk about sustainability or climate change, is where are we? What's the status? What's the baseline? We say firms need to change, but do we know where they currently are? And that's kind of the research that we are conducting at the Center for Impact to kind of establish a baseline and see how we're going to move from that. So it's a little bit like, the forecast is giving you prediction on, kind of the economic situation. We would like to give you data on what's happening with corporate sustainability. And when I say sustainability, I'm thinking about the three legs of sustainability, like ESG, the environmental side, the social side, and as well as the governance side. And so I pressed on the wrong button. How do you define corporate sustainability? There are plenty of different standards. And so what we are doing in our research is looking at the state of corporate sustainability in the most kind of biggest companies in the United States, 300 of the biggest firms from the Fortune 300 list. And the reason why we're doing this is because, well, you know, if we see what they can do, they are in general, you know, have the resources to do kind of some of the most, advanced, strategies. So that kind of gives us a good idea of what's possible. So what we're looking at is what information do they disclose in their corporate reports online in terms of sustainability and in terms of, particularly climate change. We'll talk about this in a minute. We're using the World Economic Forum description of what type of metrics are there in terms of governance, planet, people, and prosperity. So governance would be issues of corruption, for example. The environment would be, the planet would be. Okay.
Your delivery is getting a little lost.
Okay, so I think I'm not the one doing that, but you're doing this, right? Okay, so tell me if you hear me well. It's better? Okay, great. So governance, planet, people, and prosperity. On the planet side, it's about, kind of water use and carbon emissions. On the people side, it's going to be things like diversity, gender equity. And on the prosperity side, it's just about, kind of the revenues, the level of employment that companies are producing. So what do we find? How much do these companies actually disclose on these kind of elements? So here is just to give you an indication. On the governance pillar, which is a lot of things that are actually regulated, required to disclose, we have 72% of these, these 300 firms report about, kind of 72% of what's free, what is required. On the people and planet pillar, you see much less. So when we're talking about the state of corporate sustainability, the truth is that from what firms are giving us in terms of information, we don't have as much as we would like. We need more information. 28.8% here on the people pillar, all the social kind of initiative that firms are doing, and then 43% on the planet pillar, more on prosperity. So this is not great. Also, there's not much verification about, kind of this information. So we're kind of not on very kind of solid grounds. On climate reporting though, and that's kind of, where we get a little bit more information here. What we see is firms are disclosing way more information on scope 1, scope 2, and scope 3 emissions, right? Scope 1 and scope 2 emissions, kind of more direct impact of the firm, and scope 3 from the supply chain and beyond. So this is kind of a hopeful thing that, there's some information there, and we'll talk about this more. But what we see also is much less on scope 3 disclosed, but the scope 3 emissions, supply chain and customers, is actually the majority of the footprint. And so keep this in mind when we talk about these different scopes. This has implication because there are new regulations coming in. There are two things that are happening, right, in the next year, hopefully. There is the Standards and Exchange Commission that is issuing a rule that is going to ask all firms that are publicly traded to disclose some of this information. So we'll know. So next year, when we come back here, I'm going to be able to give you a better state of, kind of emissions from corporations. So that's kind of the first thing we want to talk about. What is this new regulation going to do? The second thing that is also happening is the Inflation Recovery Act, which is providing also a lot of kind of subsidies in terms of, kind of helping firms and others kind of change their behavior and invest in mitigation and adaptation, as we were talking about. So just stopping here, I want to start just, first maybe asking Kelly Clark about, what is this new kind of regulation? I mean, this new kind of proposed rule, sorry, from the Securities and Exchange Commission. What is it about, and why is it going to be important?
Sure. So the SEC this year released its proposal for companies to start disclosing climate-related information. And the motivation behind this was really the SEC is seeing a lot of the same things that we have been seeing in our research. Climate disclosures are there, but they're located in a bunch of different places. It's not clear if everybody's reporting on the same standards, and it makes this information really hard for investors to use. And investors have been clamoring for this information. We've seen a trend dating to the early 2000s of people looking for what risks companies are facing due to climate change. And some of this may be physical risks, more hurricanes, you have more potential for damage to your supply chain, to more existential risks, and are you going to get sued at some point in the future over climate emissions or climate emissions data? And so in response, the SEC formulated these regulations that cover two main principal areas. One, companies are going to be asked to disclose their emissions in scope 1 and scope 2. Scope 1 being your direct emissions, the emissions that come from machinery you own, or if you're an oil and gas company, from methane leaks coming out of the ground. Scope 2 emissions are indirect emissions that come from purchasing energy. And all companies are going to be required to disclose those in the proposal. Scope 3 emissions are much harder to calculate. Those are all of your other indirect emissions, and those can range from how you manufacture your goods, to how you distribute them, to how they're recycled or disposed of at their end of life. So as you can imagine, this is really hard for a large company to calculate. So what the SEC has done is, instead of requiring everyone to disclose these, they're requiring companies to disclose them if they are material, or if the company has set an external target, say they've set a net zero goal that encompasses their scope 3 emissions. And these emissions will be phased, or these disclosures will be phased in over time. And so along with disclosing the actual numbers, they're also asking companies to disclose risk. So they're asking them to disclose what climate risks are you facing that may affect your business operations or your financial statements. What are you doing in terms of a management strategy to address those in the short, the medium, and the long term? And what are the plans for how you go forward in this new environment? So it's really a sweeping regulation, and it's really the first one we have seen that will be mandatory for companies to disclose in the US.
No, thank you. So a question to Henry about this, SEC proposed rule. How does it differ from, kind of the requirements that publicly traded firms have to, comply with in terms of reporting? And what do you think of this scope 3 requirement? And, is it possible that any company will decide that scope 3 is not material?
Yeah, so two great questions in there. The first one is, what's different about this than what firms were previously required to do? And since at least 2010, the SEC guidance has generally been to disclose aspects related to climate to the extent that they're material, but what that's led to is a lot of voluntary disclosure, where what firms are putting out there, as you've seen in the research you were just talking about, a lot of heterogeneity in terms of organizational boundaries, what types of measures, what standards they're reporting to. So what the SEC is largely trying to do is get a better degree of consistency, comparability, and reliability, hopefully, at least in terms of a lot of the narrative disclosures. A couple things that are different, sort of first order differences. One is the disclosures of greenhouse gas emissions. Interestingly, I believe the guidance now is that the disclosure should be along the lines of the greenhouse gas protocols. There's some room, some gaps to be bridged in terms of how the greenhouse gas protocols differ from what the SEC is requiring, at least in terms of things like organizational boundaries. So what firms have to report or include for, say, when they calculate profits might refer to a different set of entities for the emissions that they include when calculating greenhouse gas emissions, which is sort of an interesting, again, area to bridge. The other area that we haven't touched on yet are what you might call footnote attributions. So when companies are facing impacts of transition risk or physical risk. So I know in the previous panel, there was a lot of discussion of flooding and how flooding might impact shipping companies. One thing that's in the current proposal, and I think it's worth noting also that it is just at this stage a proposal. There have been, I think, around 14,000 comment letters submitted. I think the SEC is trying to incorporate the comments into a revised proposal and potentially trying to get it into the Federal Register by the end of the year. So it would apply to companies as of essentially the beginning of next year. So they'd start reporting in 2024 for fiscal years starting in 2023. One thing that's required in the proposal are these footnote disclosures breaking out what are impacts of physical or transition risks or climate events line by line on the things that firms are reporting in the income statement and the balance sheet, statement of cash flows as well, potentially, which is fairly unusual. We haven't seen these attributions, at least with there's bright line 1% thresholds. Historically, a lot of the SEC guidance has been based on materiality. So what are things that might affect an investor's decision rather than just, was there a flood that affected your property, plant, and equipment value above a 1% threshold? So that is a pretty significant difference from what we've seen in previous reporting guidelines. We don't see requirements to attribute 1% effects on lines to other things like changes in employment costs or other factors, other risks that several of our colleagues were talking about in the first hour of this session.
So scope 3.
Yes.
Going back to this, because, I mean, it seems to me that if, any firm is going to look back at their suppliers and say, you need to give me your information, maybe you're not publicly traded. I don't care. I need your information because I need to put it on my, kind of reports. So this could go very far. This could mean potentially that every single company in the United States has to kind of, develop their carbon footprint, measurements. What do you think?
Yeah, so certainly the importance of scope 3 is that it looks through an entity into its supply chain, customers, not just the energy suppliers that show up in scope 2. So if a firm is required due to SEC regulations to provide reliable information about its scope 3 emissions, then it's going to have to get information about those emissions from its supply chain.
Exactly,
It's going to have to estimate those emissions from its customers. I think your research touched on some of this, but currently just the time lags in getting that are significant. So if the SEC rule goes through as proposed, the scope 3 disclosures don't kick in immediately, but eventually firms are going to have to start disclosing it on a timeline that's consistent with what they disclose for financial purposes. So 45, 60, 90 days after the close of the fiscal year. Whereas right now what firms are doing is partly because it takes so long to get this information from upstream suppliers to estimate it for downstream consumers, disclosing it with a 6-month to 1-year lag. So there's really tremendous changes if scope 3 reporting becomes mandatory. And you had mentioned that it's mandatory if it's material to investors, again, from the SEC's perspective, or if the reporting firm has set targets or goals that incorporate scope 3. So I think there's also this issue of, are firms going to try and do things that mitigate their requirement to disclose scope 3 emissions, potentially by, say, setting targets that avoid tripping this disclosure requirement.
Mm-hmm. Yeah, so I mean, moving to Jacob, in terms, I mean, from your perspective at KB Home, what would this proposed ruling change for you? Would that change anything? I mean, you clearly have done a lot of efforts on reporting. So what is your take on this regulatory changes?
It does change things. I'll start first with a little bit of history, where KB Home was and where we are today, how we're looking into at this going forward. So when we started, we were in 2008, we were looking to build more environmentally friendly homes. We established our first sustainability report to create transparency, to start reporting, but also to be a thought leader for our industry. We were the first home builder to establish that kind of report, to educate also our supply chain and to start signaling to the supply chain that initially We wanted more environmentally friendly products, home construction materials that initially we were saying that save energy and save water. Eventually, after that, we started talking about low carbon with them as well. We recognized our first supplier that brought us bricks that had lower embedded carbon in them. So I think data is great. You need it, but it starts with awareness. And awareness through the supply chain. As you said, it could be some private companies. It could be our plumber trade partner that still rolls their trucks to our construction sites. And that is part of the calculations, but they're a mom and pop company. Okay, so we started it from a different angle, from the angle of environmental or climate actions, and now we're looking at them from climate reporting or carbon reporting. It makes a big difference. And then when you bring in the words materiality,
Right, yeah.
That's a huge item right there. So
let's define materiality for those who don't always know. How do you define it? Or maybe Henry, or
Go for it, Jacob.
Well, I'm not a lawyer nor an accountant. I'm an architect, but I will say materiality is in the securities law. It's what's material to investors to know about the company and the company's balance sheet. And of course, I will just state that a lot of the carbon calculations, carbon accounting, there is still a lot of challenge in finding exact data and making it to the same level of depth and breadth and quality as the rest of the SEC accounting data that needs to be supplied to investors. So there is definitely a challenge, and it's a transition.
Mm-hmm. So how do you deal with that concretely in your company? Do you get new people coming in? I'm sure, you've invested in this for a long time. So how concretely, what do you do?
We're very clearly focusing on this right now and have been. In terms of our sustainability governance structure, we have, of course, our board of directors has insights and manages our sustainability initiatives and ESG practices. But then we have ESG committee and a sustainability, more environmental sustainability committee. And so these are all engaged and involved. At the same time, you got to look at what I call the 3 T's: talent, technology, and teachers. Talent in terms of who we are working with within our organization, these committees, and we hired more staff on the sustainability team so that we can meet the demands. Technology, we recently signed up for an ESG reporting software for the first time. We've always done it with spreadsheets and emails, and now to raise the bar, we're heading to software that really captures all that, creates traceability, creates auditability for the data. And then finally, of course, the teachers. We need advisors, whether it is for carbon calculations or risk analysis, all these things. So we're through these 3 tools together, we're gathering our team.
Okay, great. Well, yeah. At the Anderson School, we now have an ESG class. So 2 actually. So definitely some of our students will be able to help. Just one more on scope 3, and that's to you, Jacob. Scope 3, often we think about the suppliers, right? But obviously, your home, once you build them, are there to stay for a long time. And so what you put in them, is also the future footprints of your consumers. So how do you think about this, even in terms of accounting for it? How would you take credit for, let's say, I'm putting this product there, which is more efficient. It's going to be, kind of less carbon footprint for my consumers. But is it part of your scope 3? How do you account for this?
Totally. From the beginning of our journey, sustainability journey back 2008, we've done sustainability materiality analysis for our company, for our operations. And clearly from the beginning, we highlighted that item as one of the key materiality items, sustainability materiality, to say our biggest carbon footprint as a company is really not scope 1 and 2 operations as much as it is the life and the use of our product. We have a home that is going to live for many years into the future. How do we build it today that will reduce the carbon of that house throughout its life? And of course, that's a gradual thing. When we started in 2008, the first thing we did is, and we actually did it before 2008, is to seek some very good standards. So Energy Star from EPA, there is an Energy Star standard for a home as a full house, okay? And so we built our platform based on Energy Star. It's a voluntary program above code, so it's always better than the average new built home. And we started there. And then, of course, continued to increase the efficiency of these homes, added solar to the ones in California. That carbon footprint has been reducing. Of course, the current efforts and next efforts are going to be related to decarbonization of the grid and making our homes all electric. And we've increased the percentage of homes we do as all electric. We're beyond a third of our homes are currently all electric and increasing. So I think that by itself, actually, the use of our home is about 80% of all of scope 3. So if we focus on that, that's materiality.
Right.
But then we have the rest of the elements of scope 3, and that's where some of the challenges happen for us in terms of, I mentioned the mom-pop plumber that rolls their truck over to our site to do some construction there. How do we capture that? How do we capture the embedded carbon in all the materials, thousands of materials that make a house, etc.
So, I mean, that comes to you speak about decarbonization. So there's decarbonization and there's net zero. So Kelly, I wanted to ask you, so you recently conducted an analysis of the state of net zero in the US in largest firms. So what did you find?
So we looked at 200 of the largest firms in the US, and we found 115 of them have set net zero goals at this point, representing about 60%, which seems really promising. However, when we drilled down a little bit on it, we saw some more concerning elements. Not all of those net zero goals cover all 3 scopes. A lot of them only cover scope 1 and scope 2, leaving, by our calculation, about 40% of emissions covered. 60% of their emissions are uncovered by net zero goals. And we also saw that a lot of these goals are set towards 2050, which if we are looking to decarbonize rapidly and to potentially mitigate some of the worst effects of climate change, that may be too late. So what we see, we're also missing a lot of detail in them. Firms aren't publishing, or at least not discussing, their plans for how they're going to get to net zero. It's undoubtedly a challenge. We expect some will use offsets, but there's just no discussion out there. So some of the hope, for me at least, is that if these new SEC rules are enacted, we may get some more detail about how firms plan to get to net zero, which may help us figure out whether these are reliable paths we're on, or if we need to change how we are going about decarbonizing.
Right, so kind of, we're still kind of in this issue of information. We don't really know what firms are doing. It's hard to get the information. And there is some hope that this new rule is going to change something. Thinking about students and training, and how are accountants, moving on this? I saw something somewhere that says PwC said that they were going to hire 100,000 people, new people work with specialists of ESG, whatever it means. And so, what does it, what does it mean for the accounting, profession?
I assume that's directed at me. But,
yes, and
yeah. So it's a lot of work. It's just a tremendous amount of work, both for the traditional CPA firms, but also for their consulting arms and engineering consulting companies. I think what you guys have found in a lot of your research has been that if you look at the attestation or the assurance related to at least scope 1 and 2 emissions, a lot of that's done by engineering services firms. A lot of it's not done right now by the big 4 accounting firms. It's definitely an area they want to move into. As you mentioned 100,000, all of them are hiring a tremendous number. Inside firms, you mentioned talent, you mentioned teachers. It's hard to understate the need for people to develop reliable measures to track this and to make sure that tracking this develops results in actions that are relevant. Sorry, just to take a side note, we talked about materiality a second ago. Everything we've talked about so far is what you might refer to as single materiality. So it's relevant to investors. We haven't really mentioned double materiality, higher orders, which would be potentially relevant to other stakeholders. So the SEC is really focused on the single materiality to investors. Other regulatory frameworks that are coming out in other places have, like the EU, potentially in China, have a greater focus on dual materiality, impacts on stakeholders, impacts on communities, wildlife, what have you. To get back to your question, just a tremendous number of people. I know the professional services firms are training people. They're putting out tremendous amounts of literature. They're training boards, managers. They're offering their services at what I'm sure what they believe are reasonable prices. Business schools are very much in this as well. Not just business schools across UCLA. This is an area where public affairs, engineering, economics are all deeply involved.
Let's also recognize that it is dual expertise. You need accounting, but you need science as well. And
you need to be able to understand what are these greenhouse gases emission. I mean, it's not that simple. How do we train our students? We need to understand life cycle assessment, right? So all of these tools are not really yet taught in business schools, right? But if you want to have people to, kind of be able to work on this, they need to understand both. So something to think about, for us at UCLA and beyond. So I think we've been talking about, kind of the role of information, the idea being that if you know the problem, and the potential solutions to it, you're more likely to do something. So that's the first step. Let's see what is the footprint of these companies, what are they doing. The next step is to kind of motivate them to do something. It doesn't mean that you're putting out a report to say, oh, that looks really that I should do something, but doesn't mean they will do something. So now there's this IRA, kind of these subsidies coming from the Inflation Reduction Act. What does it mean for businesses, Jacob?
Well, there's tremendous investment on the part of government, and it does excite us in terms of the new technologies that they will be investing in making their cost go lower. Okay? Lower cost for heat pump technologies, for solar, and also lower cost for the homeowners to have a energy efficient home, because there is also a federal tax credit for to builders for building either an Energy Star rated home, certified home, or net zero energy
solar panels, I guess.
So I think it's that kind of investment that is a great transformational tool and a ramp up towards a better climate action by all of us.
Right. So we should be in good hands now with all of this, right? So Henry and Kelly, what do you think?
I'm hopeful. I think some of the incentives in the IRA, especially towards installing carbon capture devices and this real new innovation and technology that it's supporting, are what we need to accomplish this. Moving from not just putting the onus on firms to voluntarily do this, but giving them the tools to actually make the investments they need is a critical part, I think, of success here.
So we've spent a lot of time talking about the SEC disclosure regulations, disclosures. I think at least what the SEC is saying is we're not doing this necessarily to, well, we're not doing this to pressure firms into changing their behavior. We're doing this to provide investors with better information. Of course, that could facilitate investors making decisions differently, possibly better in terms of how they allocate capital, maybe, you know, lowering the cost of capital for a KB home relative to a less efficient home builder. But it's really an indirect path towards behavioral change. And if the SEC wants this rule to go through and be enacted, at least as they've proposed it now, they've really got to maintain that this is about providing investors with better information. As one of the dissenting commissioners said, they're not the Securities and Environment Protection Agency. So the Inflation Reduction Act, there's just a much clearer path from direct incentives, dollar incentives, to changed outcomes that would actually, sorry for using this word repeatedly, directly benefit stakeholders in terms of lower emissions. You don't have to worry about this indirect path of, is this something that investors are going to care about and maybe incentivize, you know, less drilling or more efficient energy use? You see significant rebates for both consumers, industry, manufacturing, to connect it to some of the issues that were brought up earlier. Also significant incentives if the manufacturing is done, or at least a good portion of the manufacturing is done in the US. So I think just the path is a lot clearer. And it's also an area where you see a bit of difference between the regulatory path that the US is pursuing versus the regulatory path that the EU is pursuing. So whether you've got direct incentives or it's more a disclosure path, at least on the
so the EU
side.
being broader in terms of the requirements for disclosures, but without the incentives. And the US, because I mean, they require disclosure for sustainability more generally, and with double materiality, right? So which means like the threshold to report is, you know, even lower. And then, but no incentives versus the US, you're saying it's much more focused, but we have this, you know, kind of bill coming up with bunch of subsidies.
Yeah, so holding the IRA aside, at least comparing what the SEC is putting out to what the EU is putting out in terms of disclosure rules for companies, the EU rules are more clearly directed at getting firms to change behavior, whereas that's just not something that's feasible on the securities disclosure side in the US.
Right. So I think, you know, we're kind of hopeful there will be changes that will, you know, kind of push firms in the right direction. But there are, you know, definitely challenges. They're just not obvious this rule is going to actually pass, I mean, be adopted. So this, you know, you said 14,000 comments. So there's just still some uncertainty, right, on how this, Henry, do you know, what's your
Well, there's
prognostic?
definitely uncertainty. Sorry to interrupt, but they're literally revising the proposal right now. So the timeline that I'm hearing from the professional services firms when the SEC commissioners go out and give talks is this is something that they want done by the end of the year, so that it will apply to firms starting in January 2023, such that they'll have to report out their carbon emissions and other things that get into the final rule in early 2024. So that's a pretty quick timeline. I think we talked a little bit about some hurdles to that before. It's definitely going to wind up in the courts. So there's already a number of parties lining up opposed to it, opposed to specific parts, opposed to the proposal in general. But first, we've got to see, how does the SEC revise the proposal? What do they actually pass? Historically, just to give a little bit of context, the Tax Cut and Jobs Act in 2017 passed, I think, mid-December. So it's not like the US is completely averse to passing substantive changes to the regulatory environment a couple weeks before they go into force. That was another good time for full employment for accountants, probably a very stressful time as well. But on the other hand, if you look at some of the parts of Dodd-Frank, disclosures about mining or where firms are getting their minerals, those disclosure requirements were basically held up in the courts for about 10 years. So
Wow,
I think,
okay.
depending on who you listen to, this is something that the general guidance from the professional services firms, at least, is this is something that companies should be prepared for. A lot already are because of voluntary reporting they've been doing. But we don't know what exactly it's going to look like now. And we don't know if it's going to come into force in January 2023, or parts of it are in the proposal. Yeah, it could be 2030 by the time the last parts get phased in.
We'll see.
Yeah. Sorry, I'm a bad representative of the forecast. This is very much a we don't know.
So I wanted to ask if there was any question from the audience or from the feed. Yes, please.
Yeah, hi. So I'm curious in regards to supply chain issues and with net zero goals and so forth. I'm looking at a chart from the New York Times here that shows that basically 68% of mineral processing of critical minerals like cobalt, rare earths, lithium occurs in China, which, the President of the United States just threatened with military intervention in an internal dispute about a week ago. And the fact that the mineral extraction of all of these minerals is occurring in the global south, where, labor conditions, pollution, so on and so forth, are, unknown at best. Like, how do you reconcile these, incredibly, I'll just call it utopian conceptualizations of what this world's going to become in, 10 years or whatever, with these severe resource constraints that are just not going to go away?
Right. So, I'm going to start first a little bit. What we've been talking about here is a lack of transparency in general about, kind of what firms are doing and in terms of their, footprint. One of the biggest hurdle has been in the past, the fact that we know very well what's happening within the US, but we have very little information on what's happening elsewhere. So that's kind of one of the issue in terms of, kind of getting companies to be a little bit more upfront about these things. Yes, we are in a global world. Yes, we are interrelated. Yes, it's not simple to implement all of what, kind of needs to be done. Even if you're just thinking about having, kind of electric cars in your neighborhood. Do we have the grid in place here? We're not just thinking about what you're saying in terms of, yes, we need this material that's very rare and that's in, kind of somewhere and could be cut at any point. And we've seen what happened during the pandemic in terms of how reliant we are on supply chains. And I'm sure Jacob can talk about this more. But even just having everybody having an electric car in Los Angeles is a challenge. Will our grid support this? Do we have the infrastructure? So it's not simple. We're just the beginning of this transition. And you raised an important point. So I'm going to ask, the panelists if they want to mention, kind of the difficulty to kind of sort some of these material we'll need for the transition.
Well, I think part of it is what you mentioned. It's transparency is the issue here. Right now, with the way most ESG disclosures are written, there's very little verification of them. Companies can largely say what they want, paint their actions in the best light. Getting information on the supply chain, on scope 3, on what's actually going on in a forum that has some consequences if you misreport, if you exaggerate your reporting, I think is a really important first step to mitigating those problems. But until we really know and have reliable information from companies on what they're doing, what their supply chains look like, what audits they're performing, it's hard to address a problem without really having information on the full scope of it.
So to Jacob, in terms of, kind of the difficulty to predict, supply chain, and we've seen, kind of some of this recently. So what are some of the things that you put in place to, mitigate this issue?
Yeah, clearly supply chain in the home building industry has been disrupted, but it's getting better in terms of rare earth metals and so on that may impact, say, solar and storage batteries in at homes. I think it's what you're highlighting is a great example of what a heavy lift it is to create a life cycle assessment of something like that. How do we know who's our supplier today versus our supplier tomorrow if things continue to shift and there are disruptions?
Can I just add one
Yeah, go
one
ahead.
thing to this? Like,
Thank you.
you point out something that we should all be completely aware of, that the transition to a net zero economy or trying to hit Paris goals is not free. If it were free, it would be easy and we would have already done it. There's really important trade-offs to be aware of, or actual costs. So I think transparency is helpful, but there are big ticket decisions like, where are we going to get the nickel and rare earth metals from? Where's manufacturing going to happen if we're going to try and make the grid ready for that transition or just build enough batteries? So transparency can be helpful, but there is a literal limited resources and let's say labor quality or issues there.
From my standpoint, you're looking at this, you have these extremely ambitious timeframes that we're talking about here, okay?
Mhm.
And then you have these tremendous constraints that I just described and that you acknowledged, okay? And so when you do this, you're sort of excluding existing energy sources from the current mix. Those industries, oil and gas, for example, even nuclear, those investments are not happening. And this thing is not going to just turn on a dime. Like this world that you imagine isn't just going to happen. To sit there and say 2050 is too late. Okay, that kind of rhetoric, it doesn't match up with reality. It's too late. Okay, well, guess what? You're not going to make 2050 if these resources are not available, period. So my point is this, what do you really think? Is this really the crisis emergency that has to stop everything right now or else it's the end of the world? Or are we just saying these things and trying to hope our way into this and maybe it all will work out in the end, right?
Well, I mean, I think this is kind of a difficult question. We're all hopeful that something and that our, kind of innovativeness, our creativity will be able to kind of overcome some of these barriers. But, definitely it's an enormous challenge. So it's possible that we'll go into, we're talking mitigation here a lot, but the previous panel was much more on adaptation, right? So that some of this will shift from, kind of what can we do to adapt to kind of an environment that has so much more volatility than before. And so, we have this investment coming, some money flowing. We don't know all of the details of what needs to be done. And we're kind of learning each time, we put some, we make some progress in one area and we are learning kind of some of the difficulties of this. But so there's no alternative path. We have to kind of continue, believe that we can do something, right? So.
This might be more for Dr. Friedman and Mr. Attella, but I'm a little confused and I'm not really conversant in this area as much as I'd like to be. But what is the risk to an investor, a stock investor, for example, or what is the advantage of him knowing the carbon footprint of, say, the 20,000 different products, from pipe to electrical wire to switches to wood that goes into a house, from the perspective of investing in the stock? So what is the risk that he's experiencing today in the market by not knowing how much carbon emissions under scope 3 that the manufacturers of all of those sub-products that go into a house are? That's kind of the first question. And maybe I'll just leave it there. And then maybe if you could define scope 3 just a little better. Thank you.
Okay, so at least what I've seen so far in terms of, let me just say that I think if we can think about the SEC proposal as having three main components, one would be these narrative risk and strategy disclosures that Kelly was talking about. The second one would be the greenhouse gas emissions, scope 1, 2, and possibly 3. And the third would be footnote disclosures about how much we're spending or what were the impacts of climate effects. So I would say that I think it's easier to see the value to investors of literal discussion of what are the risks we're facing and potentially disclosures of where do we have facilities, how much was damaged because of floods, things like that. And I'll invite the other panelists to contribute here, but at least some of the disclosure of scope 1 and scope 2 emissions, what are the risks associated with that, or what's the relevance to investors? Some of it relates to transition risks. So as carbon gets priced greater in the future, which may or may not happen, but there's certainly a risk of that. Depending on where you're operating, there could be greater or lesser risks. Transition risk, potentially transition risk related to customer tastes, as customers potentially favor brands that have a smaller environmental impact. And then also just, it's an indirect proxy for intensity of hydrocarbon use, which could be particularly relevant, especially as we've seen the last, I don't know, you could say 6 months, 1 year, 100 years of volatility in hydrocarbon prices. So I think that's the general narrative around it, but I would agree that it's a harder story to tell for the SEC to say, here's where we get investor materiality from scope 1, scope 2, and scope 3 emissions.
I just follow up?
Yeah.
It just seems to me that they have an accounting obligation to disclose material events. So, for example, if the cracking facility down in Louisiana is flooded and shut down, they have to disclose that. So what I'm really trying to get to is I understand supply chain risk. So most of this company stuff is coming from China. Are we getting trade war with China? Once again, that's a material risk that has to be disclosed in financing and any accounting. That already has to happen. So what I'm trying to understand is how is this carbon, this incredible accounting burden going back and accounting for the carbon footprint of every product that goes into something, sub-product goes into the final product, how that mitigates an investor's risk beyond what we already have. That's what I'm trying to understand. I'm not putting on the spot. I'm just really confused about that. I understand the social engineering, and I understand the laudable goals, but what I don't understand, going back to the commission, you said the SEC is looking at the Securities and Exchange Commission, not the Securities and Environmental Protection Commission. I don't understand, and I think you get what I'm saying. I don't understand how I, as an investor, am better off today investing in the stock, knowing that all the subcomponents that go into a coffin of a house. I know it's a house in terms of carbon. Whether the components are coming from China and they involve rare earths, or the forests in the Pacific Northwest are burning down. Well, I already know that. They have plywood built houses. So I don't understand this, but I'll read more about it.
So just to add a little bit more to it, a lot of companies have been reporting greenhouse gas emissions. It's something that at the very least large asset managers have been asking for. So there is a little bit of a revealed preference argument that the SEC is making, I believe, as well. This is something that investors seem interested in. So to facilitate capital formation and comparability, we're going to, at least in the proposal, mandate that all firms report it. We're going to give them guidelines on how to report it and how to, and where to provide information about the assumptions that they're making. We've talked a fair bit about scope 3. There's clearly a lot of assumptions being made in scope 3, but there's also a lot of assumptions that go into scope 1 and 2 calculations as well.
So on this note, unless do you have any kind of final word, anything you want to address before we close the panel? Are you optimistic about the future?
I don't know who's supposed to go first.
You decide.
I think we have to be. There's no point in not being optimistic. So I say we give it our best shot and let's see what we can do.
I'm very optimistic that we will continue to innovate and increase the energy efficiency and water efficiency of our society. I'm not an accountant or don't want to address that, so I'm going to leave the SEC side alone.
Yeah, I'm optimistic too. I also think we're, at least in the business school, we're in a good spot to help train our students and colleagues and alumni to think better about the tough trade-offs that have been pointed out already. I mean, a lot of us are trained as economists, and what we think about our trade-offs at the core of it. So I'm very happy to be in this position.
Yeah, thank you. And better information will help us do a better job evaluating these trade-offs. So thank you very much.
And thank you to all of our panelists. Please join me in thanking this great panel. And the fact that we started off with kind of some gloomy talk about recession and inflation, and we end on an optimistic note. So that's good. A couple of announcements as we come to an end. The first is I'd really like to thank our staff, Seth Katz, George Lee, and Mina Prieto. They're the people who really made this happen. And we very much appreciate them. And Richard Ziman and Stephen Gordon, who have been instrumental in bringing us a new economist who hopefully you will see in June, a real estate economist for our joint program with the Ziman Institute for Real Estate, and Edison in Southern California Edison, who are sponsors of the Forecast Fellows program, which is providing new pathways for new economists from underserved communities. So we are really thankful to them and our sponsors. We couldn't put this on without our sponsors. And so I'm just going to go through them somewhat quickly, but we deeply appreciate their sponsorship. And they include HDR, RSM, the law firm of Allen Matkins, Cathay Bank, Clark Construction, Leap Development, University Credit Union, Avenue Insights and Analytics, Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Pacific Western Bank, Robert Half, and United Airlines, and Scottwork North America, Union Bank, the private bank, Gerber Kawasaki Wealth and Investment Management, SoCal Gas. So many thanks to all of them. We will see you in December when we're going to be talking about digital currency. So hold on to your crypto until you come to our December conference, or don't. But we are going to dig deeply into that crypto, central bank digital currency. What does this mean for the world economy? What does this mean for transactions in the US? Where does all of this go, if anywhere? And that's going to be our theme in December, which we will do joint with the Think Center for Finance Research here at UCLA. So we will see you then. And thank you all for joining us in this conference. And stay tuned as the economy unfolds over the next 3 months. Thank you.